Tuesday, January 31st, here in New York City. This is Yahoo Finance Live. I'm Brian Sozzi alongside Brad Smith and Julie Hyman. Futures, well, they've been mixed all morning long as traders eye the Fed and seem to overlook some strong quarters from GM, Caterpillar, and Microsoft. Right now, at this moment, though, stock futures are in the green. Now, here are three things you need to know this morning. The economic outlook has gotten a little less gloomy. That's according to the International Monetary Fund. It's forecasting global growth will slow this year, but not as much as previously expected.
Accelerating into 2023, General Motors forecasts earnings well above estimates. CFO Paul Jacobson tells Saz January's off to a good start for the automaker.
And missed delivery. UPS reports prices up, but volumes down as it gives a disappointing full-year revenue forecast. But it is returning cash to shareholders. That's coming in the form of a new $5 billion buyback plan. But getting to our first thing that you need to know more about this morning, the global economy is showing signs of resilience, but is expected to slow further, according to the International Monetary Fund, known in your hood as the IMF. Latest global economic outlook is where they published much of their research and the outlook. And on a positive note, the IMF upgraded its forecast for world growth to 2.9% from its prior prediction of 2.7% and sees it expanding in 2024. The only major economy predicted to shrink this year is the UK. We heard from IMF chief economist Pierre-Olivier Gorinchas. Here's what he had to say.
Whether you're looking at European economies, you're looking at the US, you're looking at other parts of the world, you see labor markets that have been quite resilient. You see household consumption that's been stronger than expected, business investment. And so you put all of this together and you have a slightly more resilient global economy.
He also published in a blog that China and India are expected to account for half of the global growth this year, noteworthy given some of the stimulus mechanisms that China is also going to be putting in place as well. But that has much larger ranging implications for growth globally as well this year.
Yeah, and it should be noted that the U.S. is not the strongest part of this outlook, of course, that the U.S. growth is projected to fall from 2% in 2022 to 1.4% in 2023, and then 1% in 2024. So the globe overall is expected to reaccelerate in 2024, but not yet the U.S. So that's kind of an interesting note. Another interesting one is all of the risks that the IMF is still flagging, despite things being less worse than initially forecast. They talked about some of the potential things that could go wrong, including the recovery in China stalling out, the war in Ukraine escalating, and sovereign debt spreads kind of expanding here, which would also cause some problems, particularly in emerging markets.
Yeah, I appreciate I'll just add here quickly, I appreciate the upgrades here from the IMF, but I think the headline right on the top of this report I'm looking at really says a lot. Inflation peaking amid low growth. Inflation peaking doesn't suggest that inflation is going to come down aggressively as the year progresses. Low growth, does that mean we are in a recession? Does that justify what we've seen in the market this month? Unclear. And then we might see from the IMF, I'm joking a little bit, a couple months from now, inflation peaking amid low growth equals rate cuts. I think that's the next missing piece of this puzzle, and ultimately why we've seen this big rally in stocks here. I think investors are very positioned. They've gone beyond the pivot here, guys. I think they're just looking for flat-out rate cuts in the back half of this year.
Yeah, the IMF really telling many of the central banks to keep their foot on the gas in that instance as well here.
Yeah, I was just going to say, one question that we haven't dug into as much is, will the Federal Reserve and other central banks be satisfied with inflation being at a persistently high level if it stops going up? I mean, it seems to have stopped going up, right? It seems to be decelerating a little bit. Well, what if it only decelerates to 5%?
Well, then they stay on the gas with rate hikes.
Well, but do they or don't they, right? So I think we're going to have to see over time. The other side of the equation maybe at some point will become more important. That is the job market as well, which is the other part of the Fed's dual mandate, but we'll see. Something else we're watching this morning, China's official Purchasing Managers Index. It's a measure for manufacturing activity. It rose to 50.1 in January from 47 in December. That's according to the National Bureau of Statistics there in that country. And by the way, why is this important? This is the first expansion that we have seen in 4 months as disruptions around the abrupt end to the country's COVID restrictions, they appear to be fading. The official composite PMI, that includes manufacturing and services activity, it rose to 52.9 in January, up from 42.6 in December. Remember, 50 is that dividing line between contraction and expansion. Well, thing number 2 this morning that you need to know, General Motors reported upbeat earnings in its latest quarter. Profits rising 16%, revenue up 28% year over year. This performance comes against the backdrop of a slowing economy as rising interest rates affect things like auto loans. And Saz, I know you talked to the CFO over at GM to kind of figure out what some of the things they're watching are.
Yeah, lots going on this quarter. They uncorked a new $2 billion cost-cutting measure. Paul Jacobson telling me that January is off to a good start. That is after a strong December. Lots of puts and takes here, but I think the market is trading off this very strong outlook from GM here, well above consensus estimates. But key to them hitting that result is maybe not discounting cars as much as we've been hearing, or EVs, I should say, like we've been seeing now this week from Ford and a Tesla. I asked Jacobson about this.
It's a matter of really putting vehicles across all classes, and I think some of our competitors have struggled with the cost of battery cells, et cetera. Obviously, Tesla's doing incredibly well, and a lot of lessons that I think everybody can learn from them. But at the end of the day, it's about driving efficiencies, and we think with the Ultium platform and with our scale of manufacturing, we can offer vehicles in different classes and different segments at different price points that are better than anything out there, and to be able to do it while hitting our margin targets.
And Paul makes a good point. GM has made a different bet compared to some of its rivals. They've seemed to spread out the price points of their electric vehicles. Of course, you have the Bolt there as well. I think they will have 9 new EV launches this spring alone, more high-end and low-end. Ford, I would argue, focus a little more on higher-end. Of course, Tesla is high-end.
Yeah, and this is all going to come down to their cash flows as well, or it's going to greatly impact what those cash flows look like, especially if you do see more of a pricing war start to move forward in the EV landscape among some of the largest manufacturers, Tesla and those legacy automakers, and how it contributes to that cash flow. At least the projections right now that they're expecting net automotive cash flows provided by some of their operating activities, they're expecting that to come in for the calendar year in a range of $16 to $20 billion, and then adjusted automotive free cash flow of $5 to $7 billion. And so that's something that you could look at potentially being invested back into the business later on, even if those cash flows remain solid or come in above those targets. But then it's also the battery. This is something that we had teed up at the beginning of this week as well, and they made a significant deal with lithium. This is going to be a $650 million equity investment that is going to come through their Thacker Pass in Nevada operation, and they're expecting it to actually ramp up or add on about 1 million vehicles, EVs, per year. So that is significant. EVs, they had already had a 1 million vehicle target by 2025, and so this just adds on to some of the projections that GM is putting forward at this point too.
Yeah, interesting. He also said they will have they will continue to make V8 engines, which I thought was very interesting. But we'll have more from this interview with Paul Jacobson, the CFO of General Motors, later on in the show. All right, number 3 here. UPS missed the street's revenue forecast in the fourth quarter. Its cooling demand weighed on deliveries, declining nearly 3% from last year. The shipping and transportation giant also offered a downbeat outlook for the year as cost savings and volume declines take hold. A cautious outlook from UPS here, of course, but again, really not as bad as what we've been hearing from FedEx the past couple quarters.
Yeah.
Well, maybe not as bad. And also, if you look under the hood here at some of the other numbers that we're watching here, the company did announce that $5 billion buyback. So maybe it's throwing a bone to shareholders, but it's a bone that maybe they're taking, right? The company is also, with that CapEx increase to about $5.3 billion, is, or at least, I don't actually know if it's an increase, but it's a little bit ahead of what analysts were projecting, is trying to make sure that it's continuing to invest here in making sure that things run on time, that it's not good, that its deliveries are running as they're supposed to, even as demand is falling for absolute volume. So, maybe that's something that investors are looking to this morning.
I think one of the lessons learned perhaps for this quarter from UPS is the fact that you did have an era where they were increasing prices, where consumers, whether it's their business consumers or their end consumer at the end of the day, is bucking back at some of those prices, and perhaps you saw some of the volumes directly correlate with that. And so in a lower demand type of equation, or at least a lower volume equation, now that impacting UPS, at least in this most recent quarter, and perhaps that was one of the leverage mechanisms for individual households and businesses, was to say, all right, if we're already going to be hit by higher prices, where do we start to cut off some of the other expenses that we're going to take on, especially during a busy holiday shopping season and shipping season as well?
Yeah, I don't think this report solid. It would have been worse if it wasn't run by CEO Carol Tomé. I'll tell you that much right now. She's really focused on cutting expenses. That was some of the first things or first measures she did when she got into the company. But I don't think it sends any positive signals for how the retailers did this holiday season.
No, I don't think it does. And for retailers, many of them were passing along those shipping costs to their customers anyway. If I order through one of the apps that I have a membership on, they're going to say, okay, yeah, we're going to essentially make sure that we're going to waive some of those costs for you. But that cost can be factored in elsewhere into your experience within that product purchase as well.
Really factored into our wallet, Brett. All right, it's a busy week for mega cap earnings, and we have a slew of key economic data. Let's dive into it all with Interactive Brokers Chief Strategist Steve Sosnick. Steve, always nice to see you in studio. Thanks for coming down. Appreciate it. Big earnings morning. UPS, mixed signals across the board. UPS, not so great. GM, great. What do you make of these results?
Well, I think to me, the more interesting one is that UPS missed on the top line, beat on the bottom line, and is up. It's telling me that investors are in a fairly charitable mood this earnings season. I think we got ourselves into one of these situations, which as you know happens periodically before earnings season, where we kind of predict or expect the worst, and then when it's better than feared, it doesn't have to necessarily be good. It just has to be not as bad. And I think that's sort of the result you're seeing in UPS, and of course GM, where there is really solid news coming out. Well, of course the market likes that.
I guess then the question is, are we setting ourselves up to be burned, right? What ends up happening in this kind of situation where sentiment's terrible going into earnings season, then the companies come out and beat, and then earnings season ends, right? And you still have a Fed out there that maybe is continuing to raise rates, or are they? What's next?
Well, this time it's tougher because the Fed's actually doing something right smack dab in the middle of earnings season. Because a lot of people have asked me, what do you do about the mega caps that are coming out later this week? And it's like, you can't really put on, you don't know necessarily where to put on that trade, because where's your at money option going to be? I don't know, because I have no idea how the market's going to react to the Fed. And we could discuss that, for an hour if we wanted to. And so this becomes very tricky. I think a lot of people are hinging on the guidance. I think the guidance in many cases is not as terrible as people feared. And I think if we had a slew of really terrible guidance, that would be difficult also. But I think investors are really trying to grasp onto whatever hopeful pieces of the story they can take away from it.
Are there deals to be found then, given some of kind of the relative valuations that you would look at for even some of the mega cap tech names out there right now?
There's not a ton of, I don't see a ton of value out there. I look around and there's some names that are trading fundamentally cheap, but with tech stocks, it's a little weird because they're so obsessed with the growth aspects. So I look at like an AMD, which is trading, at I think a PEG of 0.7, or a Google, Alphabet, whatever we want to call it, trading about 1.1. But these are names that have absolute challenges too. So it's a little tricky, because are we investing in growth or are we investing in value? It overlaps in a lot of cases. Actually, I wrote something earlier last week after Tesla earnings came out. I thought was fascinating. IBM, remember, was the Tesla of its day. Now, it's before any of us were involved in markets, before I think most of us were born. I was born. I don't know about the rest of you. But and at this point, they both beat on earnings and revenues, and both missed on cash flows. IBM got savaged because their investors are no longer growth investors. They want that big fat dividend that IBM pays. Tesla investors could care less. They just want to see the growth. And Elon Musk gave very rosy projections, and that's what they gravitated to. And we had two 10+% days in a row as a result of it. So I think a lot of it really has to do with what is your mentality and who is your investor base as much as anything else. Which makes it tricky when you're looking for value in the tech sector, because the tech investors aren't necessarily value investors.
But the mentality only works as long as you have enough other people with the same mentality. In other words, if that rosy projection doesn't come true, if there still are enough Tesla boosters, say, or any other growth stock boosters, you're fine. But if they lose faith, then you're not so fine. So, like, how long is this going to remain intact through this year when the economy might be slowing, et cetera?
That's really tricky. I mean, obviously, Tesla, the faithful remain faithful. I do think a lot of what we've seen now with Tesla being one of the poster children is the January effect on steroids. Think about how many of these stocks got savaged last year. There were a lot of tax losses to be taken in 2022. You had stocks, big cap, market-leading stocks down 50%, 2/3, things like that. I'm thinking Amazon, Meta, et cetera. And I think those are the ones, when they started leading the rally, I think it's underappreciated how much of it might have been a January effect rather than the true broadening out. Now we're getting into some of Brian's favorite names leading the rally, and that leads into a whole other aspect of speculation. But I think a lot of it was January effect and just sigh of relief, from a wide range of investors.
All right, we're going to have to start Brian's watch list as well.
It's being led by Carvana and Bed Bath & Beyond, Steve.
High quality names.
High quality names.
I put it on the tee for you.
Interactive Brokers Chief Strategist Steve Sosnick, thanks for braving the wintry mix to join us in studio.
My pleasure.
Coming up, everyone, if the Fed is set to shrink rate hikes, does that mean that it's time to get into growth stocks? That's the big question. Julie's going to break down the relationship between central bank policy and big tech. Your morning brief next. The Nasdaq is off to a strong start this year as investors look ahead to the central bank's pivot towards a pause. But what does it mean for big tech companies? Julie Hyman dives into the feud between tech stocks and higher interest rates in today's morning brief. Julie.
Obviously, this is something that we have been talking about pretty consistently, right? That higher rates last year is one of the things that really damaged what happened with tech stocks. Of course, it helps take a step back and look at what happened before when rates were very, very low. And the Nasdaq kept rallying and rallying and rallying. This was a very long period. Basically, the Nasdaq 100 bottomed back in 2008 and then had about a 1,500% rally, outperforming the S&P 500, outperforming the Dow in the ensuing years as we had rates that were very, very low. And why exactly was that? Why were we seeing rates that were low that were benefiting growth stocks and tech stocks specifically? A lot of different reasons why, but the folks over, let's take a look at some of the reasons why. And now that we are seeing rates go up, what effect that's having. Now there's a higher cost of capital, right? So a lot of these growth stocks borrow, or it's perceived that they can borrow if they want to fuel different growth initiatives. And those growth initiatives can take all kinds of different shapes, including hiring more people or actually building physical facilities as well, like a Tesla, for example, building factories. So now the higher cost of capital has gone up, so it's perceived that it's going to be pricier for these companies to grow. Now fixed income is more attractive with yields going up. I mean, every investor that we have talked to practically has said that they like fixed income this year. Some of that money is coming out of growth stocks and going into fixed income. And another important reason why, and we're going to talk more with our next guest about this in just a few moments, is that the valuations are higher, because what growth and tech stock investors do is try to value these stocks against future cash flows. They are discounting future cash flows. When rates are going higher, even if maybe the fundamentals are getting better, these stocks can still look quite expensive. So that's another factor. All of this putting pressure on a lot of these tech stocks. And specifically, I talked to the folks over at Jefferies and our friend Brent Thill over there, and he's looking at the relationship between software stocks specifically and what we have seen with rates. And it's a pretty clear correlation here. So what you have here is the 10-year yield here in this bright orange color. And then you have software stocks in purple, the correlation between software stocks, I should say, and the 10-year. And then on the bottom here, energy stocks versus the 10-year. So basically what you have seen is as rates have gone higher, you've got this negative correlation between software stocks and the 10-year. Yields up, software down. Yields up, energy up. So you have these different correlations between different groups. And as we continue to look ahead to big tech earnings this week and to the Federal Reserve raising interest rates this week, let's bring in Paul Meeks, Independent Wealth Solutions Management Portfolio Manager. And Paul, thank you very much, because you were helpful to me yesterday as I was sort of formulating my thoughts around this topic. So we've got these two coincident events this week with big tech earnings and the Fed raising interest rates. Which is going to win out? Is it going to be fundamentals with some of these tech stocks, or is it going to be rhetoric from the Fed?
I think it's the latter, because what has driven these stocks up and down, as you've said, is interest rates. Whether they in the bull market were ultra low, and now they're starting to feel some pressure on the upside. Because here's the problem: some of these tech stocks, even though they might have come down a whopping 60 or 70% last year, on a absolute and even a relative basis, they're not particularly cheap. They're not bare bones cheap. And so if they're going to do well going forward, yes, we have to have some improvement in the fundamentals. And as we circle through a recession, which I think is going to be pretty short and shallow, we will have somewhat of an improvement. But if we have a terminal rate for the Fed's fund rate that is plateauing over 5%, which I think it actually will, I don't believe in the pivot, at least not in 2023, you are going to continue, regardless of any rebound in earnings, to have a valuation squeeze on some of your favorite tech stocks, because they still may be trading at 20 or 30 times, even though at one point they're trading at 60, 70, 80 times. So I actually think it is the key factor, and one of the reasons that I remain at least modestly bearish on the tech sector.
Paul, what names might get squeezed further from a valuation perspective?
I think, Brian, the ones that are particularly expensive, I know everybody wants to pile back into something like an NVIDIA. NVIDIA in the age of artificial intelligence, obviously the play, probably no question about that. But the ones that have very high valuations, still have very high valuations, I think are somewhat at risk. And then, of course, you have the companies that were really COVID beneficiaries. They benefited from things like remote work. They never had great cash flow forecasts. They were what I call profitless prosperity companies that are all revenue and no cash flow or earnings growth. Those could be squeezed a hell of a lot more.
Paul, Julian was just breaking down how rates impact tech stocks, but has execution or lack thereof also play a role? We came on air, just before we came on air, we got news of NetApp laying off 9% of its workforce, Workday 3% of its workforce. That's a terrible job by these guys. They couldn't forecast any of this?
You're absolutely right. What happens is they get so caught up in that feast and famine routine. You think that with a close look at their businesses, they wouldn't have hired so many people. I think they hired people with the false belief that COVID was the new normal, and we wouldn't actually morph back into something more normalized like we had pre-pandemic. And so, yes, somebody like Amazon has fired 18,000 people. I know that sounds like a big number, but they have 1.5 million employees. And so what I'm worried about, Brian, is as we get through these quarterly earnings and as we go through into the March quarter, the June quarter, particularly the September quarter, we start to roll into a recession, then you might have layoffs that make the current layoffs look like child's play. I think they may have to lay off many more folks, and that's unfortunately very sad for those people.
Paul, there are some parts of the consumer environment right now that are already feeling what a recession could look like. And you think about some of the lower income households and how that may even permeate over if we do see more of the employment situation start to sputter, or at least add on some more of the layoffs that you're talking about or forecasting. What that may actually look like and transpiring through to some of even the largest cap company names that we were talking about in tech a moment ago.
Yeah, you think about it, consumer electronics has already really felt the pinch. We've seen a big drop off globally in smartphone units, and we've seen a bigger crash in PC units. And I don't expect those markets necessarily to rebound so quickly. So be wary of your favorite tech stocks, particularly if they're still relatively and absolutely expensive, that are focused on consumer electronics, because that's all about discretionary spend. And then on the enterprise side of the house, we've seen it time and time again, something like a Salesforce.com, they see their enterprise customers really pulling back as well. So I worry about those very pricey software companies, and I worry about, on the consumer side, those folks that are dedicated to consumer electronics.
Good warnings for sure, and cautions. Paul Meeks, great to talk to you as always. Independent Wealth Solutions Management Portfolio Manager. Thank you, Paul.
Be well.
Coming up, Caterpillar posting mixed results in the fourth quarter. We'll break down some more earnings reports. Plus, we've got the opening bell on Wall Street next. Well, we're just about 30 seconds, a little more than 30 seconds till the opening bell on this Tuesday morning as we continue to sift or wade or whatever analogy you want to use, sink in the earnings. Hopefully we're swimming. And it looks like investors are watching those individual names too, because overall we are not much change, but obviously, as is typical during earnings season, we're seeing a lot more movement on the individual levels for these various names. So here we've got the opening bell this morning, watching a lot of big themes, and I guess one of our takeaways from our conversation with Steve Sosnick at the top of the show is overall things are shaking out better than estimated by and large, or maybe just expectations were so bad going into this earnings season that companies couldn't help coming out and kind of beating the worst case scenarios out there. But that said, it's sort of a tepid victory.
Yeah, it's very, to Steve's point, there were very clear winners and losers this earnings season. Overall, the season has not been good. Estimates tracking below estimates. We're seeing a lot of just earnings downgrades by Wall Street. But on the winners camp, you have a company like a ServiceNow. Losers camp, a company like 3M.
Well, and there's the beating on the numbers and there's beating on the vibe, right? Because these companies, as we know, don't always trade on what you can see in black and white in the report. There are small things that investors focus on, or just general sentiment.
Yeah, there's also, to that point, Julie, reading a lot of the earnings call transcripts, of course, they hit after the earnings call, but there's also changes in what analysts are asking. A lot more questions on free cash flow, a lot more questions on operating expenses compared to the fourth quarter. And of course, all those things are important, Brad, when the economy is slowing down.
Yeah, spot on. We're taking a look at some of the activity early on in today's session. We are higher on the Dow by about 0.2%, net lower over the past 2 days, though, by about 0.7%. We'll see if we can get into positive territory and add on to some of the gains that we're seeing out of the gate here today. And the Nasdaq Composite, you're seeing that up by about 0.3% for the tech-heavy average, net lower, though, by about 1.7% over the past 2 days. Big down day yesterday we saw. And then additionally, S&P 500, you're seeing that higher out of the gate by about 0.2%. Again, still net lower by about 1.1% over the past 2 days here. Let's also take a look at some of the sector activity out of the gate. Let's move this board over. There we go. 11 S&P 500 sectors for you folks. We got them dialed up here on the screen. Discretionary, it actually leading the charge right now. It's up by about 0.5% here out of the gate this morning. And then additionally, you've got about 10 out of 11 S&P 500 sectors in positive territory. Surprise, surprise, energy pulling up the caboose there right now, lower by about 0.5%. And then also want to take a look at some of the Dow components here on the day, as you had some fresh earnings come through that we're about to break down for you here in just a little bit. But there you're seeing one of the moves in teeing up our conversation. Caterpillar down by 3.4% right now, Julie.
Indeed. So let's talk about Caterpillar, shall we? The company reporting mixed earnings for the fourth quarter. The construction equipment manufacturing missing estimates on the bottom line, but did see revenue increase 20% year over year. But its raw materials costs to continue to go up here. Freight costs as well continue to go up. So that seems to be what the problem is there at Caterpillar. It is having an effect on profit margins, and investors definitely not liking that. There's also a goodwill impairment charge tied to its locomotive business. So that's also something that's putting some pressure here on the company, and that's why, you guys, the shares are down. Now, Caterpillar is frequently seen as a bellwether, right? Has a lot of geographic reach, touches a lot of different parts of the economy. So the fact that its sales beat, I guess, is encouraging on that front. But the fact that, it's echoing, like we've talked about, was it Colgate that talked about still rising costs as well? Like, companies are still suffering from these costs going higher.
Yeah, the revenue, double-digit gains in a lot of businesses for Caterpillar, but I took a different approach this time. Usually I focus in on their construction business, but if you go to Caterpillar's earnings release, go down to the last segment. That is the financial products segment, and here I'm just looking for signs of economic stress. Are we in a recession? And I always, to your point, Julie, look at Caterpillar as an economic bellwether. At the end of last year, past dues at Cat Financial were 1.89%. That is down versus 1.9% at the end of 2021. So that's actually a good positive economic indicator. Write-offs were $46 million all of last year compared to $205 million in 2021. So if you're looking for signs of economic stress, you didn't really find it here in a Caterpillar, which of course not only touches the U.S., but China, Asia, and other.
And we're talking about equipment financing, just to
That's
be precise
correct, yes.
there with those financial products.
But investors here today, perhaps forward-looking, and if you read into this one line from the chairman and CEO, Jim Umpleby, saying this was one of our best years in our nearly 100-year history. If there's anything that investors might take away from that, that signals tough comps in the future as well. And then you also think about perhaps one of the bright spots that they could be able to capitalize on, and you talked about the international portion of Caterpillar's business. It's what type of stimulus in construction projects may actually take place in China as well, and where they might be able to benefit from that. However, investors perhaps lingering on some of those tough comps that they're seeing be signaled, at least here in this report.
And let's stay on this theme of economic stress or lack thereof. McDonald's topping estimates for the fourth quarter as U.S. same-store sales grew over 10%, driven by higher menu prices and higher ticket items. And these results, again, for McDonald's blew away estimates. Global same-store sales up 12.6%, U.S. up 10.3%, double-digit gains in all regions of operation for McDonald's. Where McDonald's is getting dinged is their operating margins came in below analyst consensus, and that is raising the question, are they driving their sales by focusing too much on value meals? So something to tuck away there. But again, to see McDonald's put up these results tells me, not all is norm out there in the economy, and you may be reaching for $6 Big Macs instead of $25 Olive Garden nights out.
Well, when there is any type of weakness that we see in the consumer discretionary spending, and then additionally in the type of spending that they're doing in that restaurant experience or that dining experience, you got to protect the McNuggets if you're the McDonald's brand out here, because at the end of the day, the Golden Arches is going to be able to continue to cement itself as one of those value plays for consumers that they continue to maintain mind share. And how they're going to continue to maintain mind share over the course of any type of shallow or mild recession, whatever that may be, is continuing to lean further into not just the digital investments that they've made, but also how they can connect those digital investments with some of the value menu items as well that they've put on the table. But
if they're spending too much on that, they're going to get dinged, and that's what's happening today. That
So is their
margin, that margin number is why
Supersize.
the stock is down.
Well, this quarter driven for McDonald's by the McRib. If you really want to tie everything together, we saw news of Impossible Foods laying off 20% of its workforce beyond his cutback too. Maybe people are just reaching for this cheap meat instead of more higher-end plant-based meat.
No, I'm protecting the waistline on that one. No, not doing the McRib. I'm sorry. Let's also talk about Pfizer here this morning in terms of protecting your body. This just dovetails right into it. Pfizer reporting an earnings beat for the fourth quarter, topping estimates, but issuing some weak guidance for its COVID-19 vaccine as they expect sales of Paxlovid to decrease 58% from 2022, which, yeah, it probably should. And given the fact that you've seen so many people over the past 2 years, and for Pfizer, for Moderna, being able to benefit from their messenger RNA investments and the research and development and technology there's a lot that could bring to the table in the future for Pfizer, but as of right now, it just signals that there are going to be more costs, more investments that they have to make into those projects, and a lot of trial phases set to go forward in order to make sure that at a time where they're making those investments, you're also still seeing some consolidation for existing diseases or existing treatments so that they can bring those in-house as some patents start to roll off as well. They're going to be able to invest in that as well.
Yeah, Pfizer's been trying to put out this message that the COVID party, for lack of a better word, was not going to last. The pace of these COVID-related revenues were not going to last, even as it really transformed the company. And CEO Abu Borla has talked about it's transformed the way that they think at the company, that they can be more nimble, that they can take big risks, et cetera. All of that said, even as it's been messaging that things are changing, the COVID vaccine and Paxlovid numbers are going to be lower than expected. So, you can do all the messaging you want, but if the reality on the ground is that it's going to be worse, then it's going to be worse, right? So now the question from the investment community is, what is indeed next? And part of it's going to have to do with the investments that you talked about in some of the new drugs and trying to meet the next challenges, the next medical challenges that come up. But for right now, they're really in a transition period.
And I'll just add here quickly, one of the biggest challenges might be just to maintain investor enthusiasm. Some last year revenue, $100.3 billion, all-time high for Pfizer. Guidance for this year, $67 billion to $71 billion. So a major deceleration plan year over year. And it will be tough to, I think, for Pfizer just to command that really relative premium multiple here to the broader market, given how far revenues might trail off.
All right, taking a look at shares there. Over the past 2 years, net higher by about 19%, but here today, down by 2% on the earnings results. Guys, coming up, Exxon posted record profit in 2022, but the stock is still falling. We're going to discuss that next. ExxonMobil smashed profit estimates in 2022, rising 157% to a record $59 billion. That works out to around $6.3 million per hour. Yahoo Finance's Ines Ferre joins us now to discuss. I had to catch myself for a second there as I was reading that, Ines.
Talk about profit. Yeah, this was a record year for ExxonMobil. $56 billion, as you just mentioned, beating earnings expectations for the 9th time in over 10 quarters. Adjusted earnings per share, $3.40. Also, ExxonMobil talking about taking a $1.3 billion charge because of European windfall taxes and also asset impairments. But look, it was a record year for one of the so-called super majors. Returning cash to shareholders has been something that these big companies, these big oil companies have really wanted to do, versus also, of course, the political criticism of investing more in order to bring down the price of oil and also to bring down the price for gasoline for Americans, et cetera. So much was made of last week's Chevron's announcement about the $75 billion share buyback program. ExxonMobil, though, they have increased their buyback program several times last year, in December of 2022, to $50 billion for their back buy program. So they're staying put for now. No new dividends announced, 91 cents per share for dividends, no additional buybacks announced. They have already announced their big one back in December, and you can see the stock reaction, which was down right now. But nevertheless, a good year for ExxonMobil.
Yeah, and it's interesting about that buyback because even though Exxon has given back so much cash to shareholders, they wanted more, didn't they? I mean, it seems like that's why the stock is down today, because somehow there was this expectation that they would follow Chevron. And they haven't, because they've already been giving out so much cash to shareholders.
Yes, they did. And, one other thing that Wall Street is also taking a look at is also, though, investment in the Permian Basin. And both ExxonMobil and Chevron, they announced that they will be growing their investments in the Permian Basin, but compared to the previous year, not as much. So that also could be something that is weighing on the stock a bit. But look, the analysts that I've spoken to that have talked about ExxonMobil, they really look at this company. One analyst comparing it, talking about flexibility, plenty of investment options. They do have a differentiated upstream project as well that they highlight. So, and upstream is exploration, drilling. So look, it is still a Wall Street favorite. These stocks have done really well. ExxonMobil last year, about 80% upside that you saw gains on ExxonMobil. So you're looking at, Chevron was more than 50% last year. So you're still looking at some good performance. And going forward, maybe not as much, but still good performance going forward.
Yeah, and a 3% yield on top of it, or 3.25% yield.
That's right. Good analysis. Appreciate it. All right, when times get tough for the economy, the consumer gets shopping for big deals at TJ Maxx, Marshalls, Ross Stores, and other off-price retailers. Goldman Sachs analyst Brooke Roach charted same-store sales for off-price retailers compared to GDP growth. You can see there on the screen that when GDP has dipped, off-price retailers tend to see a sales lift. Coming up, we'll dive further into my chat with GM CFO and get a broader look on auto stocks with BofA analyst John Murphy. We'll be right back.
We've seen incredible demand for our EVs, and we're launching even more this year. And we've seen consumers, really run towards them at the price levels that they are. So we feel quite confident with our strategy. Look, competition in this business is no surprise. We've been dealing with it for more than 100 years, and one of the things that I think we've said over time, this isn't an easy business to get into, but one that we're ready for.
That was General Motors CFO Paul Jacobson as the company revs up its push into the electric vehicle space. While our next guest says GM is managing its core business well amid its EV push, he is predicting a challenging environment for the auto space in 2023. Joining us for more is BofA Global Research Senior Automotive Analyst John Murphy. John, always great to get some time with you. Now, Paul, right there, he pushed back on my question on if GM is going to have to lower prices for EVs. Didn't say, hey, we're going to chop prices and go back to an 80s-style price war. But do you think GM is going to have to make some moves here?
So, at the moment, the current price cuts by both Tesla and Ford that have been announced in the U.S. market are a little bit confounding because demand is exceeding supply. So, Elon on their conference call or the fourth quarter call was saying his demand is 2x his capacity. So, cutting price is kind of an odd thing when somebody is looking at demand well in excess of supply. And similarly, Ford has kind of alluded to demand exceeding supply. So I think GM is taking a more balanced approach here. And letting the market come to them. And if over time they need to make price adjustments and be competitive in the market, I think they will. But I actually think that they're taking a much more balanced, appropriate response or actions relative to the market dynamics at the moment. So I think they're actually doing a better job than the other folks at the moment.
So what does that mean for some of their free cash flow goals that they've set forth?
Sure. I mean, I think that the biggest risk or depression in the free cash flow number is the fact that CapEx is ramping up to support these EV launches over time, not necessarily the pricing actions or lack thereof in the short run. And GM stepped up its CapEx outlook to 11 to 13 billion. They did about 9 billion last year. That 11 to 13 billion sounds like it's a relatively sticky number, at least for the foreseeable future. So that's actually where there's some significant risk or pressure on free cash flow in the near term. Beyond that, the ICE business is performing incredibly well, particularly on the truck side and on the fleet side. And I think this is something that is often missed when everybody's very concerned about what's happening in the auto industry and the retail consumer. Is that fleet over the last few years has been unsatiated as far as its fulfillment or its demand, and that is an opportunity to potentially really grow volumes in reasonably good, profitable fleet volume over the next couple of years, and particularly in this year. And we saw this coming out of 2009 and 10 and 11, there was a big fleet recovery relative to retail, and that really dragged the industry out of the last trough, and we think that's probably what will happen here.
I want to talk a little bit more about EVs for a second, John, and particularly this investment that GM has now made in Lithium Americas to try to sort of ensure its lithium supply chain for its batteries. Do you think this was a good move to make? Do you think we're going to see other automakers making more moves like this as well?
Sure. The vertical integration is something that these companies are getting deeper and deeper into, a la, and following Tesla's lead on this. Obviously, there's massive concerns around sort of the critical minerals and sort of the potential shortages that we may see in the future around nickel, cobalt, magnesium, graphite, all the key materials that are going into batteries and electric vehicles. So vertically integrating like this and making these investments seems like it's going to be necessary to protect supply. Forget about even pricing on that side in the near term. GM claims it's locked through 2025. These are programs that'll start supporting them or protecting them for 2026 and beyond. But no, this is a growing trend, and it is part of the reason that these CapEx numbers are growing for these companies. I think there's $1 billion explicitly in there for this vertical integration that GM has highlighted today. So, no, it's going to be an increasing capital burden on them, but it should protect supply and hopefully pricing to some extent going forward.
And John, Paul also mentioned a new $2 billion cost-cutting plan today that they unveiled. Now, he said they're not going to see or orchestrate mass layoffs, but does that new plan now put the ball in the court of a Toyota and a Ford, where they now have to find somehow to cut billions out of their cost structure?
So when you look at these companies, there's a constant drudge to efficiency and cost cutting that must go on in good times and bad times. So GM has laid this out over the next 2 years. Mary alluded to this being sort of in their structural costs, or the structural cost being reduced by $2 billion. So, I think this is kind of ordinary course for the auto industry. I mean, you're looking at companies. I mean, GM's revenue was $157 billion last year. So eking out $1 billion of cost, per year is not necessarily, that massive in the. I mean, it's difficult. These things are very difficult to do, but not really unheard of in the industry. I do think, one thing to also consider is that they are looking at a new labor contract that will be set hopefully late this year with the UAW master agreement negotiations between GM, Ford, Stellantis, and the UAW. And there is risk that there could be some labor cost inflation that comes in that has not been really well discussed at the moment. So that's another risk that's out there. Their organized labor are great partners in their plants. They're great partners in this EV transition, but they're probably going to be more expensive going forward. So that might be an offset to that $2 billion cost saving they're looking at.
Back on the EV pricing, John, do you anticipate Tesla having to cut prices again? And then if they do cut prices, what do you do with the stock?
Well, there are a lot of reasons that Tesla may have cut price. I mean, one may be that demand is weakening. The second, and that may be true. The second is the competition is heating up. We know that factually based on our Car Wars analysis that way too. The third might be that the IRA caps, they were above and they wanted to dip, below those so that they would qualify for the IRA, tax credits for their consumers. And one may that he just wants to drop the hammer on competition and really make their competitive position that much stronger and everybody else weaker. But I think the real reason that they cut price is to broaden the market because there's only so much room to sell $55,000 vehicles, globally. So if you want to increase your volume from 50% a year from about 1.3 million last year to almost 2 million this year, you're going to have to go down in price. I mean, it's just the market is not there. You have to go deeper in the market. And they don't have an entry level or a vehicle below the Model 3 or Y until 2025. So there is risk that they cut price again in 24. Now, based in next year. But based on the statement that he made on the fourth quarter earnings call saying that his demand is 2x his supply, you'd be silly to cut price, right? You'd be just eating into your profitability. And not achieving any more incremental volume in the near term. So I think there's risk of another price cut in 2024. But if we hear another one this year, it doesn't seem very logical to us at all and really puts into question whether the industry and its executives are making rational decisions. And at the moment, it seems like they are actually being kind of irrational on this price cutting so far.
Well, I bet consumers like it. John Murphy.
Good for consumers.
Bank of America Global Research Senior Automotive Analyst. Love the toy car collection you got behind you, John. Thanks so much for being with us today.
Thanks for having me.
Coming up, a raft of results hitting today and all that ahead of the Fed tomorrow. Whew, we're going to do a quick check on some market movers next. It is, of course, a jam-packed earnings week as investors also look ahead to the first FOMC meeting of the year. Checking in on the market action right now, we have just a tepid rally for the S&P 500, up about 0.25%. The Nasdaq doing a little bit better, up about 0.5%, and the Dow just hanging on to gains, but it's been sort of bouncing between gains and losses. And as we continue to talk about the Fed, just want to take a look at bond yields here. Today, we are seeing not much movement here. 3.51% is where we find the yields. What we have seen this year is a little bit of downward trajectory for yields as well. That's one of the things that has been helpful to tech stocks. But of course, we'll see if that changes. Really, the rhetoric coming out from the Fed tomorrow is going to be super important. And then, of course, we continue to watch earnings as well. Here's a heat map of some of the big companies that have come out. We've talked about a lot of them. We're going to talk about Spotify a little bit later. Whirlpool is one of those we haven't yet spoken about. The shares aren't moving much. They're just up about 1/3%. The company did come out with some more positive commentary for the full year, saying this year's revenue is going to fall 2%, but that's not as big a drop as analysts had projected. It also said its expenses are going to go down by $800 to $900 million as inflation, as cost inputs and things like steel and other things it uses to build its machines, that they fall and operating margins improve. So the stock getting a little lift, but not a huge one here this morning. If you look at how it has done year to date, it's already up about 9%. Coming up, Goldman Sachs is predicting a probability of 45 to 55% that a recession could happen in the U.S. We'll discuss what that means, the implications for investors on the other side of the break.
Good morning, everyone. Happy 10 a.m. hour to you. You're watching Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman and Brian Sazi. We're taking a look at the markets this morning. 33 minutes into trade. We're higher across the board. You got the hat trick or the trifecta just barely by the hair on the chinny chin chin because the Dow is just flat barely to the upside there, up by about 4 points. S&P 500, that's up fractionally by about 0.2%. Nasdaq Composite, that's also higher by about 0.4%. We've got some economic data as well that the markets are certainly digesting this morning. January January consumer confidence in the U.S. that came in at 107.1. That is versus the median estimate, the forecast of 109 there. The present situation confidence rose to 150.9. That's versus 147.4 last month. And the expectations in consumer confidence, they actually fell to 77.8. That's versus 83.4 last month. Well, investors, they are certainly looking to corporate earnings for signs of a slowdown in the economy, as well as cues on how the largest companies are handling higher input costs. Meanwhile, the Federal Reserve's latest interest rate decision, that's looming in the background, with traders expecting further rate hikes to slow the economy. Joining now to assess the risk of a U.S. recession, we've got Brett Nelson, Goldman Sachs Investment Strategy Group's Head of Tactical Asset Allocation. Great to have you here with us this morning. Take us into your perspective, your insights into how you see, of course, coming into this next decision from the Fed, how you see that playing out within the markets.
Yeah, well, thank you for having me. So there's no question that investors are facing a lot of uncertainty this year. We have the path of the economy, inflation, as you said, what central banks around the world are going to do, and of course, geopolitical risks. And for that reason, we've titled our outlook this year, Caution Heavy Fog, because we acknowledge that, even as you said in the lead-in, that we're putting about even odds on a recession this year. But paradoxically, given that backdrop, you would think that our advice to clients would be to, bunker down and be very defensive. But in fact, we think that clients should stay invested. We do not recommend that they should be positioning themselves exclusively either for a hard landing or a soft landing. But we think that because not all recessionary paths lead to negative equity returns at the end of this year, that in fact, a moderate risk portfolio could actually do quite well this year with high single-digit gains. And therefore, we recommended that clients actually stay true to their strategic asset allocation this year, despite the uncertainties.
Brett, get even more tactical for us here. Just given the outlook that you are talking about, where can one go to generate alpha? What sectors, what strategy should they be putting in play?
Yeah, so because we have, this kind of, uncertainty that's overhanging the outlook, we're not recommending at this point big deviations, as I said, from that strategic asset allocation. But we do have some tactical positions in the portfolio. So more broadly, we prefer duration over credit risk this year, given that we do expect interest rates to come down in an environment of below trend growth, and the Fed probably closer to the end of their hiking cycle, obviously, than the beginning. That's a departure from last year, where we actually favored credit over duration, given an expectation of rising rates. And so having one's bond allocation, to its full extent is actually an interesting position today, given that one, if you do have a recession, it's a good hedge for that outcome. And secondly, in our base case, the returns look attractive there. And then we also have a few tactical positions in Europe. We like the European energy sector. We're also overweight the European banking sector. And then here in the US, we have an overweight to the MLPs, or the master limited partnerships, which are the pipeline companies that basically transport gas and oil around the United States.
Interesting stuff there, Brett. I'm going to take sort of the opposite side of this, because you have a lot of ifs in the report, and you make it clear that there's still a lot of uncertainty. And we mentioned before the break that you've got you're assigning about a 45 to 55% probability that there could be recession. You say in your report, if a recession is averted, financial market returns in 2023 will be less volatile. So there's a lot of questions out there. What is sort of the biggest risk area if we do enter recession? Where do you not want to be invested in case that is happening?
Well, I think, it really depends on a lot of different factors. I'd love to give you a clear-cut answer, but I think at the end of the day, the depth of the recession is a big factor, and when the recession ends is very important. So as we detail in the report, even if we were to have a recession this year, and even if that recession were to end by the end of this year, we actually think that would still be consistent with our base case forecast of the S&P 500 delivering something close to double-digit returns. Now, that may seem very counterintuitive, but when you look at the dynamics around recessions, what you see is that the earlier they start, the more time the equity market has to recover, because at the end of the day, we know equities are forward-looking. They tend to bottom about 6 to 9 months before earnings reach their low point. And the recovery from once they bottom to the end of a recession typically tends to be about 20% over a course of 3 months. So even if you had a recession that ended in December this year, given that equity markets would be rallying into the last quarter of the year, based on the historical analogs, that could still get you to positive returns. So the bad case scenario is really that we avert a recession this year, or we have a recession, it's much deeper than we expect, or that it lasts a lot longer than we expect. But as I said, given the contours of what we're talking about, and as we talk about in the report, U.S. economy is very well balanced today. Doesn't have the cyclical excesses that typically precede past recessions. Consumer balance sheets are healthy, et cetera. And therefore, we think that if we did have a recession, it would likely be mild. And that's why we're kind of leaning in that camp of positive returns, even in the advent of a mild recession, provided it ends by December of this year.
We've continued to hear that consumer balance sheets are healthy, but given the fact that consumers also have been hearing the word recession perhaps every single day for the past year at this point almost, is it possible that you could have a consumer behavior that actually starts to act like we are in a recession well before one is actually declared, or the deepest kind of elements of a shallow or a mild recession are actually seen in the data? And what kind of broader implication might that have in the pull forward of the behavioral economics of it?
Yeah, it's a really interesting question. We know markets are forward looking. We know that people generally adapt to conditions. So, arguably the flip side of the argument you're making is that people are so fatigued with the idea of inflation now that investors, consumers, they've already made the requisite adjustments in their spending and other things because they've been dealing with this overhang of recession risk, literally since the first 2 quarters of last year. Recall, we had 2 quarters of negative GDP and everybody started talking about recession. And in fact, what's interesting is that if you look at the count of stories on Google, or you were to look at, just general story count around recessions, we did this analysis, and there was actually more stories on recession last year than there was in 2020 when the US was actually in a recession. And similarly, if you look at the percentage of economists that are forecasting a recession for this year, it's the highest on record. So arguably, our view at least is that from a financial market standpoint, markets are forward-looking. They tend to look at what's happening around the turn. And part of the thing that's led to equity drawdowns in the past is the fact that people were surprised by a recession. This is arguably the most anticipated recession we've ever had. And therefore, we think that would dampen any downdraft just because the market and consumers, businesses have had a lot of time to acclimate to this idea that there might be an economic contraction and adjust their behavior accordingly.
Brett, I certainly contributed to that last year. I think I wrote about recession for 30 straight days in 1 month. True story. Goldman Sachs Investment Strategy Group Head of Tactical Asset Allocation, Brett Nelson, good to see you. We'll talk to you soon.
Thank you.
Yahoo Finance's worst company of the year for last year is off to a sizzling start from a stock perspective, even if the fundamentals of the business do not warrant it. Shares of Carvana have surged about 107% this year, or on the year so far. Despite that hot start, at $10 or so a share, the stock is still well below the record high of $370 in August 2021. That was, of course, fueled by everyone buying used cars at the height of the pandemic to avoid public transportation or park in a new suburban home's garage. Coming up, bidding farewell to an icon. Boeing is ending production of its 747 jet. Julie's back with that and more top headlines next.
Let's get down to business now. Look at some of the other headlines that we are watching. Among them, the Biden administration set to end the COVID-19 emergency declaration in May, signaling that the pandemic has entered a new, less urgent phase. This is even as about 500 people a day are dying in the U.S. still as a result of the disease. As the declaration winds down, it means less free provided or reimbursed testing, although COVID vaccines will still come at no cost. It also means the conclusion of Title 42, the controversial U.S. border policy that allows for the emergency expulsion of migrants. The overall emergency declaration was first issued under President Trump and extended multiple times across 2 different administrations. UBS has beaten expectations with fourth quarter earnings while also announcing a $5 billion share buyback. Switzerland's biggest bank did, however, see a dip in revenues on slower client activity. UBS's all-important wealth management division, usually a key focus for investors, benefited from the higher interest rate environment. It posted a 35% increase in net interest income. That's effectively the difference between the interest a bank earns and what it pays out. Those shares down about 1%. And the end of an era. Boeing delivering its final 747 jumbo jet from its Puget Sound factory in Washington state. This one headed to cargo carrier Atlas Air. That jet was first introduced in 1969. They ended up building a total of 1,574. Separately, Boeing is reportedly set to increase production of its 737 MAX jet with a 4th production line to keep up with targets. This move codifies a shift in air transportation to smaller, more efficient planes, with the new production line set to be added in 2024. Sas?
Spotify out with earnings, adding subscribers during the quarter. Those numbers, one of the key metrics investors are watching as the streaming service grapples with advertising costs and higher headcount. Yahoo Finance's Ali Canal has the latest. Ali, really a strong market response for Spotify. Stock's almost 10%, is the 3rd most visited ticker page on our platform. Where did this quarter even come from? Because they've been struggling.
They have been struggling, and honestly, I think investors are just very happy with the fact that Spotify's growth at all strategy, that seems to be no longer. Daniel Ek admitting on the earnings call that he got, quote, carried away with the investments in 2022, and that in 2023, there's going to be significant pullback when it comes to some of that spending. We did see layoffs at the company last week, along with a restructuring of its organization, and Spotify said that that's due to both speed and efficiency. That is the motto for 2023 and beyond. He even said, you know, I know investors, they probably don't believe me, but I am very, very staunch in this. Driving efficiency is paramount for this company at this point. I also think investors are happy to see those subscriber numbers continue to tick higher, a beat on monthly active users, a beat on premium and ad-supported subscribers. The company guided that for the first quarter, they expect subscribers to come in at 500 million, beating estimates on the street of about 492 million. So that's a positive, but we did see widening losses. We did see a slight miss on revenue, but gross margin, that is also another key metric for investors. That came in above expectations at 25.3%, but is expected to dip in the first quarter as some of those investments from the end of the year continue to trickle through. But for now, Spotify really confident that throughout 2023, you're going to see an easing on some of those cost pressures.
And Ali, the company surprisingly did not raise prices on its U.S.-based subscription plan. So what was your reaction to that?
I was very surprised there was no announcement on price hikes, especially since at the end of last year, we saw price increases at both YouTube Premium and Apple Music. And analysts have been largely expecting this too, considering those widening losses, which we did see in Q4 as a result of those heavy podcast investments, higher personnel costs. Ek did say that there have been constant discussions surrounding price increases and that they have raised prices in 40 markets outside of the U.S. They said their approach to pricing is a balanced portfolio approach, so it's possible that we could see price increases over time. But I think people think it's interesting that they're sort of waiting back to see how their competitors do, to see if that influences those subscriber counts in any way. But for now, they're growing exponentially on the subscriber and user front, so they might not have to do it quite yet. But I think eventually we're going to see those price hikes go up. I just think that's inevitable at this point.
All right. If those price hikes go up, they won't be getting my business. I can tell you that, Ali.
Apple Music is raising prices too. Apple Music, they'll raise prices too, Brad. Don't you worry.
They already did.
Again, they'll do it again.
Yahoo Finance's Ali Canal. Thanks so much for breaking down Spotify earnings for us. Be sure to tune in 11:30 a.m. Eastern Time today. We're going to take another dive into podcast earnings or the earnings with New Construct's CEO, David Traynor. He's one of the biggest bears on the street on the stock here for Spotify. Well, coming up, investors aren't loving earnings results from McDonald's, the Golden Arches. We're going to break down the numbers next. McDonald's investors aren't loving its Q4 earnings report, despite the fast food company posting a 12.6% increase in global comp sales for the year and citing continued guest count growth. BTIG Managing Director and restaurant analyst Peter Saleh joins us now alongside Yahoo Finance's Brooke DePalma for the conversation. Peter, thanks for taking the time here with us this morning. First, to kick things off, your perspective and takeaway from the earnings, given the stock reaction that we're seeing here on the day.
Yeah, great. Thanks for having me on. So, look, I think the reaction isn't a function of their performance in the quarter. I mean, you had 25% same-store sales growth on a two-year stacked basis. I mean, really, that's quite unheard of in this space for a company of this size, and they beat on the bottom line. So I don't think it's a function of what happened in the fourth quarter. It's really a function of the outlook for 23. They're making some additional investments to support franchisees in Europe in 23, given all the inflation that we're seeing there. Additionally, they're expecting maybe restaurant level margins to be a little bit lighter than what was initially anticipated by the street in 23. So I think those two are kind of pressuring the margin a little bit on their outlook for 23 and causing the stock to be down, just a low single digit decline in the stock today.
Good morning, Peter. Also on the call this morning, McDonald's announced plans to open 1,900 restaurants in 2023, 400 of which will be here in the U.S. and internationally. You speak to franchisee owners often. Do you think that they expected this aggressive of a growth plan here?
Yeah, so look, I think the growth in the U.S. is still going to be rather nominal at best. I think they're going to open about 100 stores. They're going to close maybe another 80, get to about a net number of about 20. But from our conversations with franchisees, they've been telling us yes, I mean, we need more stores because the volumes in the stores that we have grown so much that we need to offset it with additional units. So we're not surprised that they're trying to accelerate development. I mean, they told us even about that maybe a year ago, and they told us about it a couple of weeks ago that they want to accelerate development. So it's not really a surprise on the development side, given the strong same-store sales that you're seeing across the board.
Peter, McDonald's specifically called out strengthening the McRib in the U.S. business as a key same-store sales driver. Are they wrong to potentially be taking this item off the menu? And why is a sandwich like this continue to be so popular?
So, you know, in the past, they've taken it off and they brought it back. So this is something I think that will be pulsed in. This is not the end of McRib. McRib will come back at some point. Maybe it's not 23, maybe it's 24. Who really knows at this point? But look, it's working for them. So long as it continues to work and drives customer traffic, they will continue to pulse it back in. It's just not a permanent piece of the menu. So I suspect you haven't seen the end of McRib quite yet.
Very interesting stuff there. Let's keep to here in the U.S. Frequency for low income was higher this past quarter, but transactions were down slightly. Should that continue, do you think that consumers will trade down? We'll see more consumers heading to McDonald's?
You know, what was most interesting on the call is that they actually said that they're seeing the frequency of their lower income consumers actually increase, but that they're coming in and being a little bit more, I guess, budget conscious and spending a little bit less. I think that's a good sign. I think that just suggests that, you know, the consumers still want to come back to McDonald's. They just have less to spend, which is fine for the time being, but they're visiting more frequently. And I think that's more important than anything else. So it seems like the lower income consumer is doing a little bit better. We've heard some of those comments at a conference that we were at earlier this month, suggested that things have stabilized a little bit with that low income consumer. So we just don't see it getting really that much worse. It seems like even the comments from McDonald's today suggested that, you know, the lower income consumers holding up better in the U.S. and in Europe, better than they actually expected.
Even though at this point it's costing McDonald's a little bit, right, because of sort of the mix and what these consumers are buying. I'm curious, Peter, what the read-through is for the rest of the restaurant industry. I mean, McDonald's is the first big company to report here. What does what they've said tell us about how the industry is going to do?
So, I mean, McDonald's really is the bellwether for the industry, right? I think they're taking share, so I don't expect all the rest of the operators to put up numbers similar to this. I think McDonald's is definitely taking share, but you can see that the health of the industry is clearly there. Additionally, they commented on January. They said, you know, look, good weather, lapping Omicron has really helped us in January in the U.S., maybe even over in Europe. So I think you're going to see that continue. They also commented on commodities. Commodity inflation is moderating. McDonald's had mid-teens commodity inflation in 22. It's expected to be mid-single digits, maybe as high as high single digits in 23. We think McDonald's will probably be on the higher end versus the industry. We think the industry will be more like mid-single digits in 23. So you're seeing a moderation in commodity inflation. You're seeing same-store sales hold up fairly well. Pricing is flowing through. That low-end consumer is holding up. Frequency is starting to improve. So it seems to us like the industry is rather healthy, and I think it's going to see that reflected in many of the other names that report over the coming weeks.
Do you think that the industry will still continue to make bets, and bets like the McPlant? If you've got a company in McDonald's that's prioritizing a lower income consumer or leaning into the McNugget staples, even, if you will, what does that mean for some of those bets that they've made on plant-based options on the menu too?
Well, look, McDonald's has tried the plant-based options last year. I think it launched around Valentine's Day. It ran for about 8 weeks and seemed to just not resonate with consumers. So at this point, I think it's on the back burner. Look, McDonald's is focused on the core of the menu and the things that drive the vast majority of their sales. They're not really exploring options outside of that, and it's working, right? The drive-through speeds are improving. Their same-store sales are accelerating. Consumers are reacting to what they're putting on the menu, which is honestly less alternatives. They're not branching out and putting on plant-based meat items or a lot of menu innovation. They're focusing on their core, and that's been working for them really since the pandemic. So I don't expect that to change anytime soon.
Big Macs or bust for McDonald's. Let's leave it there for now. BTIG Managing Director and Restaurant Analyst Peter Saleh, thank you so much. And alongside our very own Brooke DePalma. Thanks so much. Appreciate it. Coming up, the IMF strikes a more upbeat note on the global economy. We'll have a chat with IMF's chief economist next.
Welcome back to Yahoo Finance. I'm Jennifer Schonberger. Well, the IMF raising its outlook for the global economy this year on better than expected resilience in economies across the globe in the face of high inflation and interest rates. The IMF now sees global growth reaching 2.9% this year. That's 0.2% higher than previously forecast in October. I sat down with IMF chief economist Pierre-Olivier Grinches to talk about why the IMF's outlook has brightened slightly. He told me that he doesn't expect a global recession this year and that on a headline basis, inflation has peaked globally. Take a listen.
Yes, you're putting it the right way, just a little bit more optimism. We have a slight upgrade to both 2022, 3.4%, and then 2023 at 2.9%. And so what we're seeing is sort of low growth, still relatively low compared to historical average, 2.9, but a little bit higher than expected. And perhaps more importantly, we're also seeing it bottoming out. So after 2023, bearing, any unforeseen shocks, and of course the last 3 years are not exactly been very, very calm, but we're expecting things to bottom out. So what's behind this? Well, in a nutshell, we've seen a lot of resilience in a number of economies throughout 2022, despite the really severe shocks, the cost of living crisis, the energy crisis, that has happened as a consequence of the pandemic and then the Russian invasion of Ukraine. And so whether you're looking at European economies, you're looking at the US, you're looking at other parts of the world, you see labor markets that have been quite resilient. You see household consumption that's been stronger than expected, business investment. And so you put all of this together and you have a slightly more resilient global economy.
So then, given what you just said, is the risk of a global recession less than perhaps what folks previously thought, perhaps what you may have thought, even in the face of still high inflation and rising interest rates?
Yeah, so here I want to emphasize, it's still not very strong growth. I mean, 2.9%, if we look at the average from 2000 to 2019, global economy used to grow at about 3.6, 3.8. So we are far from that. So it's still relatively soft. But 2.9 is well above the usual markers that people have in the back of their mind when they think about global recession, with something between 1% or 2%, something where income per capita would be stagnant or even declining. So we are not seeing a global recession in our baseline forecast. I want to flag that there are a number of risks, a number of things that could go wrong in this year or the next year. And so, this is just a baseline projection, and there's still a risk.
Speaking of those risks, looking and reading through your report, you note the downside possibility of course, lower growth, but also higher inflation. So I wonder what the prospect of stagflation could be.
Well, so on this, the news is somewhat also improved compared to our previous round of forecast. What we are seeing on the inflation front right now is headline inflation. So if you look at, overall cost of living indices have peaked in the last part of last year and are now coming down. Broader measures of inflation that are more exclude energy and food prices, what we call core inflation, these have not yet peaked and come down in many parts of the world. In the US, they've started already very recently, but in other parts of the world, they are not. But overall, this suggests that we may be on the right trajectory in this fight against inflation. So there could be bad news on the inflation front. There could be an increase in input cost coming from energy prices, or maybe a very rapid increase in input cost, labor cost, that would again push up inflation. But what we're seeing right now is relatively encouraging on the inflation dynamics looking forward. So again, 2023, growth could be bottoming out, inflation could be coming down. This could be a turning point.
Pierre, on central banks, the Federal Reserve is expected to raise its benchmark interest rate to a range of just over 5% to 5.25%. Now, if financial conditions loosen, we could see that Fed funds rate move a bit higher. My question is, what level do you think would be appropriate for the Fed funds rate? And should the Fed hold at that higher level through the end of the year? Or what is the prospect that it could begin cutting towards the end of the year as the markets are pricing in?
We think that the battle is not won yet. We've had a few good prints, but it's too early to really declare victory. And central banks are announcing that they want to get into this tightening territory and hold it there until new data comes in, until they figure out how quickly inflation is coming down, which way they need to go from there, whether, to keep hiking because inflation proves more persistent, or instead to start sort of adjusting down if the news are indeed good, seems right to us. So right now, we are seeing a path where, Fed funds rates are going to be rising above 5% in the course of the year. That seems appropriate in our view.
And so then building on that, we look at the outlook that you have for the U.S. economy, and you're actually more sanguine than the Fed is. You're penciling in 1.4% GDP growth for this year versus the Fed at 0.5%. Do you think that the U.S. can avoid a recession here and get that so-called soft landing? Or depending on how long the Fed holds at a more elevated level on interest rates, or perhaps the job market turns, we're now seeing mass layoffs outside of the tech sector, could that spell a potential for negative growth?
Well, there is a lot of worry about the labor market turning around and all of a sudden having mass layoff. And clearly, this is something that could happen. But let me remind everyone of where we are right now. We are having a labor market that is as tight as it's ever been. Around 2 vacancies per unemployed worker in the U.S., historically low unemployment rates. So this is a situation of very robust, very strong labor market. Central banks, the Federal Reserve, by tightening policy rates, is going to cool off the U.S. economy in the course of the year and into 2024. And we are expecting the unemployment rate to rise. Actually, our forecast is for the unemployment rate to be around slightly above 5% in 2024. So there will be an increase in unemployment. That does not necessarily mean a recession. Going from 3.7 to 5.2 or around those numbers is not necessarily associated with a recession. So we still believe there is a narrow path to avoid a recession in 23 and 2024 for the U.S. economy, but it is a narrow path, and there could well be a recession if more tightening is needed or if there are some more adverse shocks.
Now, Grinches also warned failure to raise the U.S. debt ceiling would be a huge blow to both the U.S. and global economies and could create problems in the U.S. Treasury market, a pillar of the international financial system. He urged all parties to come together to avoid default. And we'll be right back after this.
Bitcoin has soared nearly 40% in January, closing in on its best monthly performance since October 2021. For more on why investors might be getting back into the digital token and how that bump in trading activity could affect exchanges like Coinbase, let's get to JMP Securities' Devin Ryan. Devin, thank you so much for joining us. And it's not just that Coinbase might track with the price of cryptocurrencies. It's that, as you argue in a recent note, that it is sort of better poised to benefit from rises in cryptocurrencies. What do you think are the most important changes that Coinbase has made?
Yeah, well, it's been a pretty eventful month for the industry, but also the players like Coinbase in the space. So we put out a report 3 weeks ago, crypto needs to get serious. And the whole point of that was that, really we get to move from this kind of hype cycle to projects that have real utility, and ones that do can earn value over.
Oh, I think we have a freezing for Devin. Devin, can you hear us? Nope. Yeah, it seems like we are going to try and get him back in just a moment here. or are we going to talk to Sazi now? Okay, we're going to take a quick break. We'll be right back. All right, let's bring back in Devin Ryan. He is Director of Financial Tech Research at JMP Securities, a Citizens company. Devin, thanks for bearing with us there, and glad we got you back. So I had just asked you what Coinbase has done to sort of right the ship here and make it well poised, perhaps, to take advantage of any crypto rebounds. What do you think?
Yeah, so it's really a couple things. One, they got a lot leaner, and we've been arguing they need to get their cash burn down, and they announced a 25% expense reduction. That's a huge deal to be in a position where they can weather really any environment. And so they announced that about 3 weeks ago. And then the other things are a little bit outside their control. You know, you just need prices to recover and volumes to recover. And what's been really encouraging to us is the fact that, Julie, as you mentioned in the lead-in, you know, market cap in crypto is up like 30% over the last 3 weeks. Coinbase's volumes have followed that. So what that means is that people really didn't leave the market altogether. They just moved to the sidelines. And now that prices are moving back up, engagement's there, and Coinbase is seeing about $2 billion of volume a day in trading. That compares about less than 1.6 billion in the fourth quarter. So they're seeing actually a nice bump up there, and that's driving much better revenues.
So in that stabilization story, doesn't there still kind of have this larger component? Isn't there this larger component still of regulation, and what regulation comes forward to really thrust any type of confidence into the space?
Yeah, so regulation is obviously a big question mark. You know, our view has been that really crypto is I think an industry where both the left and the right have views and can come together here. And regulators ultimately, in our opinion, are not going to crush industry, but they do need to give better rules of the road for the industry to operate. And so I actually think that is coming, and that's going to add clarity and be a good thing for firms like Coinbase. You know, the uncertainty is worse than having certainty. And so I do think we're moving closer to that. That'll be a good thing. But ultimately, you know, the company does need to be in a position where cash burn is lower and they can operate and weather any cycle. And I think they're now in a much better position post these recent cuts to do that.
Do you see them having to cut again?
So I think, just to give you some context here, so at the current volumes that we're tracking in the industry, about $2 billion a day, as I mentioned, they're actually operating at about cash break even at that level. So this is enough to sustain them. They have $5.6 billion of liquidity. I think the question would be, is there another exogenous event that happens that drives volumes way back down below kind of what we're all modeling? And that could be a scenario where they could cut again. They've got levers to do it. So we're very pleased with their willingness to, I think, get leaner. And that's something we've argued they needed to do. So they're in a good position from here. Their cash flow break even. You'd really need to see a pretty material step back in volumes from here to justify that.
And so, given the contagion events that have already taken place to this point, how does that shift some of the sentiment, even around some of the offerings that Coinbase does have in even storage and storage or staking? How does that kind of rattle those businesses individually?
Yeah, so again, I was talking about a report, you know, that we put out 3 weeks ago. Crypto needs to get serious, and the whole point of that is that there really needs to be projects and offerings in the space that have real utility versus, I think, some of the hype and in some cases even fraud that we've seen over the past couple of years here. And so, Coinbase is a leader in the space. They're going to do things the right way. And I think this is an environment, I covered financials through the financial crisis, and the good firms that were doing things the right way actually gain market share on the other side of that. I think Coinbase is going to be a firm like that on the other side of this environment. But really the crypto offerings themselves and the projects, you need to see real utility come through. And we highlighted in that report 70 projects that are, boring healthcare and logistics and transportation, not the hype projects or meme projects that have gotten a lot of attention in the market. And we think that's going to be healthy for this whole space, and we need to progress there over the next couple of years.
Bitcoin as boring, goal to reach for, I guess. Thanks so much, Devin. Good to see you. Devin Ryan of JMP Securities, a Citizens company. Appreciate it. Well, the first month of 2023 is in the books, and despite the bombardment of seemingly bad news, stocks have clocked in some impressive stats. So what could possibly bring this upbeat action to a screeching halt? Saz has got a downer for us today.
Yeah, I'm just running through some stats here that come compliments of our friend Keith Lerner over at Truist. Really has been an amazing start to the year. First stat number one, and our full story on this now on our homepage, but Keith noting the 50 worst performing stocks of last year are up an average of 20.1% this year. The 50 best performing stocks from last year, meanwhile, are only up an average of 1.9%. Just, I think, also ties back to what we wrote in the morning brief earlier in the week. It is a bizarre time to be an investor. Just given stats like that is just pretty interesting. Number two, a lot of these stock gains have been driven by higher price to earnings multiples. Keith notes that earnings estimates for the S&P 500 have ticked down to 11-month low, but valuations through the prism of price to earnings ratios about 18 times. That's at the high end of the range seen over the past decade of about 18 times to 18.5 times. So very interesting to see that as well. And then lastly here, Keith noting there's indiscriminate buying happening across the board. Remarkably, all 50 of last year's worst performing stocks are up this year. So just, again, the market's out of the gate very strong this year. Some zany, wacky moves, especially in the context of earnings season not necessarily going great for a lot of companies.
That's not unusual. Like every start to a year, you see some of the
every start to the year's up.
I mean, I don't know if it's quite as universal, but I think that happens. Like, I feel like that happens at the beginning of most years, is that you see a flip at some of the narrative from the last year. I don't know. Maybe I'm just relying too much on my own faulty memory, which, admittedly, it's not the best source.
It's just the magnitude. To see the 50 worst performing stocks last year, I imagine those are companies that have been fundamentally damaged, or even, of course, some tech names too looped in with a lot of these layoffs. But a 20.1% gain is just is mind-blowing. And to this point, not to rain on anyone's parade here, the fun time and the take is the fun times could be crushed by the Fed. Obviously, all these moves, to Keith's point, have been very speculative here. I think based in large part that we do get that pivot in rates. maybe some rate cuts later this year, but the Fed could really, I think, crush a lot of these folks out of these stocks very, very soon, and it could happen this week.
We'd never like to see the sad SARS graphic there on the screen.
Oh, I didn't even notice that. That was good. Oh, that was cool. I like that. Yeah. I don't like being sad. I want to be happy.
Yeah, everybody wants to be happy.
Yeah.
All right, well, let's stay happy here for a hot second here. I think with our, actually, no, it's not with this story. We got one later on, though. But time for Cup of Time, 3 stories, 1 minute each. We got the lightning edition today. We start with this. Six Flags shaking up its board of directors, appointing Marilyn Spiegel, effective immediately. Spiegel is going to stand for election with the other 6 directors at the theme park companies 2023 annual general meeting here. And this is kind of a direct correlation to the activist campaign that had been moved forward there as well. Within Six Flags, they had an activist investor.
Land and Buildings.
Land and Buildings, yes, that was
indeed.
looking for more of the profitability to move forward around the real estate assets at Six Flags.
Wish them well. Unclear. I'm sure Marilyn seems very experienced how one new director on this board, 6 board members standing for re-election, are going to drive a lot of change at Six Flags. Just make better rides, make things cheaper, and serve better food.
And she's got a big background within the casinos as well. Wynn, as part of that background, Wynn Las Vegas.
Maybe I'll place a
Encore.
bet that I'm going to get off a roller coaster safe and sound. Maybe I can do that on my mobile phone. Six Flags puts it out there.
I don't think I've gone on a roller coaster in a while.
Yeah, I won't place any bets that I won't get off and get sick. Not get sick, because that is unfortunately what happens to me.
All right, more job cuts are coming. Workday and NetApp are the latest companies to announce workforce reductions, with Workday slashing 3% of jobs and NetApp laying off 8%. And I love what Paul Meeks said earlier on. We asked him about some of these layoffs. These executives just need to do a better job. Unclear to me if each of these companies have chief economists on staff, but if they don't, I encourage them to take the money from that they're saving by laying off all these people and go hire a few, because they could have did a better job.
What I find fascinating about the Workday announcement, it says this was not the result of overhiring. Well, like sort of by definition, it was the result of overhiring, wasn't it?
Yes.
And they said they don't plan to do any more layoffs. So they're just trying to sort of make a distinction between them and other companies to say they weren't mismanaged.
It's taken 2 CEOs now to make that decision. So interesting to see Workday making that happen.
I mean, but it also speaks to the demand pipeline that has been pulled so dramatically forward and now is impacting their ability to just operate on a similar basis as the time when they had more of a rosy environment for people demanding or switching over to a Workday product as well at the end.
Like Six Flags, I'll apply it to Workday. Just make better software.
Better software, better roller coasters, better cardboard.
Better paper.
International paper is rising this morning after topping fourth quarter estimates. Its CEO says the company is well positioned to navigate 2023 economic conditions. What is so interesting to me about the cardboard business? It doesn't really make paper anymore. It makes cardboard and it makes pulp. Raw material to go into paper, sells that for paper makers. What's interesting here is you see the likes of a UPS, you see the likes of what we might be expecting from Amazon, where you have seen maybe a little bit of decline in volumes, right, of stuff that gets packaged into cardboard, and yet international paper here doing pretty well. Net sales were only up 0.9%, but packaging, I should say, was down by 2%, but the raw material stuff did better. So, and it sounds like the margins here are doing okay.
So is what's net good for the environment, I guess, with less packaging, bad for international paper then?
In theory, but they're doing okay.
Packaging, I like when I order from Whole Foods. I love that packaging, Julie. Big fan, big fan.
You're just teasing me because I said yesterday I don't like, and by the way, that's not made from paper. That's those like composite plastic bags. Yeah.
Nobody likes to feel
I'm glad you amuse yourself, Brian Sazzi.
I do, you have to.
Coming up, Rachelle Kubo's going to have you for the next hour of trading. Plus, Sazzi's going to have his full interview with GM
cool.
CFO Paul Jacobson. You don't want to miss that.
Big.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. On the upswing, stocks take their cues from corporate results ahead of the Fed, with some strong beats from the likes of McDonald's and UPS. We'll take a closer look at the crucial chip sector with AMD and Qualcomm set to report. And music to investors' ears. Spotify shares pop as it beats the street with fourth quarter revenue amid stronger user growth. But investment in podcast spending eats into its bottom line. We'll get analysts' take on this hour. And a disappointing outlook. Pfizer says its breakneck sales growth will come off the boil this year. We'll deep dive into the pharma giant as demand for its COVID products tapers off. But first, let's see where the major indices are sitting 90 minutes into the trading day, as we see there a little bit of trepidation there as they await the Fed, but still at least in positive territory. You see the Dow there up about 1/3%, the S&P up 2/3%, and the tech-heavy Nasdaq, buoyed by some of these earnings coming out, up there more than 1%. Let's also check in on the Treasury market as well. Of course, always closely watched with any Fed decision. We see it's a mixed picture here, though. You're seeing the longer-term yield there up just slightly, about 1/3%, the 5-year down 0.8%, and the 10-year down about 1/4% as the Fed meets today. All right, well, earnings season is in full swing as investors digest the flood of quarterly reports. We have Yahoo Finance's Jared Blickery here to highlight some of the day's victories and losses, along with some key earnings to watch this week. Hey, Jared.
That's right. Let's get to it. We got some winners and some losers. This is our earnings heat map. Oh, let me get to this. This is our earnings heat map of what's happened today. Now, let's start with Spotify. This stock is up about 10%. Let me just show you on a one-year basis what it's done. Now we can go through some of the numbers. This is the highest price that we've seen in Spotify since September, and that's after beating expectations on the key metric of premium subscriber gains. And you can count 10 million of those people in the fourth quarter. Now, leading Bloomberg Intelligence to suggest that, quote, guidance for 2 million additions in the first quarter may be conservative, so maybe some upside there. Also, gross margin catching the eye of Citigroup. They rate it with a buy with a price target of $140. They're saying that they should elevate the stock along with the monthly active users beat, and this is because the biggest concerns, or this is in spite of some of the biggest concerns, being that the macro environment and a slowing economy may weigh on the stock, but I think everybody's kind of saying that. Now, here's a max chart, and you can see a lot of stocks like this look like that round trip over the pandemic. Now, it's kind of a long slog to get back to the top, but a decent start there for Spotify. Now, we got to get to ExxonMobil, and let me dial this down to a one-year chart. We're talking about records for the oil major. Now, they missed on revenue, but they posted a record profit of $59.1 billion for the year. Now, this is a bit shy of the $98.8 billion that's expected from Apple this Thursday. But when it comes to cash flow, it's knocking on Apple's door there too. And let me just show you this chart that we have prepared here. This has to do with the cash flow, record cash flow raked in by U.S. companies as part of the S&P 500. Here's Apple, the top spot in 2022. They raked in $122 billion. And then at the bottom, we got Exxon. They raked in $76.8 billion. So for the U.S. oil majors, it's all about the return of cash flow. And now we want to move on just a little bit here because we got McDonald's. Now that stock is taking a little bit of a hit here. It's down about 2.5%. And let's see what we got here. We can see it's in the upper end of its range here on a one-year basis. The key metric of global same-store sales, that was a nice beat for the comps. That was up 3% in the quarter. Now, CEO Chris Kempczynski highlights the company's focus on technology, also its ability to deliver options through that delivery system. That's reaping dividends for the company. Now, the delivery sales more than doubled in the quarter, and after the bell, guess what? Focus going to turn to AMD. So let me get up our chip sector here. Now, the chip sector is very highly levered to the business cycle, meaning that has the vicissitudes of the ups and downs. We can see AMD up 2.5% today. Chip stock's doing pretty well this year. You can see AMD is up 15%, and the company is potentially set to beat its chest about its prospects for growth this year. And this is amid a general malaise among its competitors. So AMD is still making headway into the server space, and if Mark Zuckerberg's metaverse dream ever comes true, AMD is set to profit. Now, traders are pricing a 19% move after the bell, so stay tuned. You're not going to want to miss it. We're going to bring that to you live. Guys?
All right, great stuff. A very, very long play on that metaverse, but we're seeing a lot of movement in metaverse.
It could
Some people
happen.
still bullish on it. It could, anything could. Great stuff there, Jared Blakary for us. All right, well, staying with the chips conversation, the United States reportedly furthering its crackdown on the Chinese tech sector, and specifically Huawei. Now, this as the likes of AMD and Qualcomm gear up to report quarterly results. Here to discuss the wider sector is Thomas Hayes, Great Hill Capital Chairman and Managing Partner. Good to see you, Thomas. So a lot to unpack here. Thank you. So as we look at some of the pressures that are in this sector, give us the temperature of what's been happening as we look at this push by U.S. policymakers and the ripple effects.
Yeah, it's been a strong move. Since October, the U.S. kind of made U.S. chip makers get a license in order to sell advanced, calculations and semiconducting equipment to China. So moving forward, the big news now is that they've gotten the Netherlands and Japan to join on restricting exports of advanced chip-making equipment. This is a big deal because ASML focuses on the extreme ultraviolet lithography machines. They're the only company in the world that makes them, whereas Japan focuses on the deep ultraviolet light lithography machines. And this will hamstring China's initiative to develop their own semiconductor business domestically, but it won't completely impair it. I mean, right now, SMIC, which is the big fab that was developed in 2000 to compete with Taiwan Semiconductor, is producing chips at about 45 nanometers versus Taiwan Semiconductor, though, is producing at 7 nanometers. So I think the big issue that came today is now it's a unified front. It's not just the U.S. unilaterally making these restrictions. It's now the Netherlands and Japan, which are the major suppliers for this advanced machinery.
And obviously, this is coming at a time where we have a chip glut at the moment, and we're seeing that ripple effect then affecting some of these Asian suppliers as well. What is the outlook then? Because obviously, demand isn't going to be picking up anytime soon from some of the estimates that we're looking at. What is the play here for some of these chip companies?
Well, we may have hit peak inventory, and usually when we hit peak inventory historically, the sector starts to rally in anticipation of it easing. And we may have actually seen the bottom of semiconductors in October. I know that's hard to believe when you saw Intel really not deliver what everyone expected last week. But I think if you look longer term, and I think we're going to see some more green shoots from AMD tonight, and maybe even Qualcomm. Qualcomm is with the handsets, but AMD has the data center. And the PCs has been the most hurt. The other thing to keep in mind when you see like Texas Instruments, the auto industry, the amount of chips that go into each car is accelerating, and there's been 2 years of pent-up demand for new cars. We do think used cars will do poorly in the next year or two. However, we think new cars with dealer incentives, and you're already seeing it with Tesla cutting prices, with Ford following suit with their Mach-E, that demand for chips and capacity is going to shift to auto chip demand. And with the average car on the road at 13.1 years old, Rochelle, I think that the chip sector is going to do just fine reallocating that capacity until the data center, the PC, and the handsets recovers after some pull forward in 2020 and 2021.
I mean, and as we look at things like handsets, in terms of strategy, we're looking at Samsung. They're actually going to be keeping their capital spending at last year's levels when you have Micron, Hynix, Kioxia all pulling back on their spending. What's your take on that strategy? What could they potentially be risking by focusing so much on market share that they might end up losing out on profitability?
Well, I think they're certainly playing the long game. I think you saw the IMF last night come out and say that global growth was going to be better than expected. I think a lot of people really underestimated the impact of China's reopening. You know, the government set 5% reopening targets. The government in China has also been stimulating and easing since March of last year, but it didn't matter until they opened the doors and allowed people to leave their apartments and get back to life. All the stimulus in the world wasn't going to help. Now it's all happening at once. You have 9 months of backlog stimulus, monetary policy easing, coupled with people getting back to life and the pent-up demand, revenge spending, revenge travel like we saw in the U.S. from late 2020 to 2021, that's now just starting. And I do think those 5% GDP targets that the government set are going to be very, very conservative. And we're seeing a lot of banks now come out expecting growth. And what that means for the global economy, a rising tide lifts all boats. The second largest economy in the world is going to grow faster than expected, and that's going to help Europe tremendously, which is why everyone calling for a recession in Europe this winter has been incorrect. In part, number one, the U.S. has stepped up as a natural gas producer, but number two, that China reopening is really helping get things back in gear. And number three, it's going to help U.S. earnings, and that's a key factor moving forward because the S&P 500, some of the considerable amount of those earnings will benefit from China's reopening as well. So I think things are pointing in the right direction, and I think Samsung might be right to play the long game, pick up share while everyone else is weak. Inventories are peaking, and then when the demand picks up in 12 or 18 months, they've gained share.
Now, it's interesting because Samsung is expecting the chip recovery to begin in the second half of this year. Are you seeing anything though that supports that kind of recovery starting that quickly?
I do. I see it in the auto sector. So you have seen capacity reallocation. So where there's excess supply in the handsets and the PCs, they've been moving towards auto. And every single company that provides auto chips has been reporting, record sales. Demand is picking up, and you're seeing it also in the automakers starting to rise because they're finally getting the chips they need to sell cars. For 2 years, on the one hand, they had the luxury of selling above sticker, and people would pay whatever they could to get the limited supply. Now the chips are coming in. The semiconductors companies are making a lot of money on the chips. But now the OEMs, the car manufacturers, are putting supply on the lots. They're going to start to do incentives, and you're going to see a massive amount of new cars. So we do think used cars will do very, very poorly over the next 12 to 24 months. New cars are going to do much better than expected. Everyone's saying in a slowdown, no one's going to buy new cars. But in a 7% interest rate environment, when the dealers start coming out and saying 0% APR, 2.9% APR, you can buy it at sticker or below sticker, I think people with their 13-year-old cars on average are going to get out there and take advantage.
That offer certainly will start looking a lot better. A big thank you there. Thomas Hayes, Great Hill Capital Chairman, Managing Member. Thank you so much. All right, well, General Motors with a better than expected quarterly results, exceeding analyst estimates, driven again by record revenue and strong demand. Revenue surged 28.1% in the quarter as its Chevrolet Bolt EV and Bolt EUV saw record sales for 2022. The auto manufacturer also forecasting another solid year of results in 2023. And make sure you stay tuned for more on GM. Yahoo Finance had the chance to sit down with General Motors CFO Paul Jacobson. We'll hear more on what he had to say on the quarter later this hour. All right, coming up, it's a wild time to be an investor. So are ETFs still your best bet for making gains amid an uncertain backdrop? Our next guest says new products and issuers mean the good times aren't over. More next.
Federal Reserve is expected to announce it will continue hiking interest rates as Fed officials meet for their first policy meeting of 2023. Here's what you need to know. Economists widely expect the Fed to raise interest rates by a quarter point at this week's FOMC meeting, further slowing the pace of increases following a year of aggressive action to tame inflation.
They're telling us the intent is to take policy into a restrictive stance and then to hold there for an extended period of time.
But the battle against inflation is complicated, and the Fed walks a fine line between bringing down prices while also avoiding a major recession.
We do have weakness in a lot of data, but they're focused mostly on the labor market, and the job gains, while decelerating, have still been pretty resilient.
Although job growth has slowed in recent months, the unemployment rate remains at historic lows, coming in at just 3.5% in December. The latest inflation data has also shown some easing. The PCE index coming in at 4.4% in December, down from 4.7% the month before, though that's still much higher than the Fed's preferred 2% inflation target. The economy is beginning to show cracks in other areas as well. Consumer and business spending slowed in the fourth quarter, followed by weaker retail sales and recent layoffs across the tech sector. Fed officials will be weighing all of these factors as the central bank determines its interest rate policy, and investors will be watching closely for new insight into how much further rates will rise and any signs the Fed may pause in the near future.
Well, investors may be warily watching the Fed's balancing act between its fight against inflation and the threat of recession. Now, the uncertainty leading some analysts to consider ETFs this year for investing. Here with more, Ben Slavin, BNY Mellon Global Head of ETFs. Good to see you, Ben. Obviously, investors have a lot to take on at the moment. You have obviously that Fed uncertainty, this holding pattern that we're in at the moment. What are some of the top questions that clients who are perhaps interested in ETFs really have for you right now?
Well, certainly investors are watching the Fed, but we see ETFs off to a strong start here in 2023. But what the data shows really is, to some degree, a lack of conviction. We've seen it really flow across the board. And what's interesting to note is, with all the investor choice that's available in the ETF market, we see investors looking at actively managed ETFs here in January, both in fixed income and equity, as a way to potentially play this market and potentially get some advice.
And Ben, I want to talk about some of these inflows. We're seeing 610 billion inflows into ETFs last year. You're predicting a record $1 trillion this year. What is going to get it there?
Well, look, we've seen an acceleration of ETF flow into the market. Investors just simply choosing ETFs as a preferred way to invest, really at the expense of mutual funds. And we saw that trend play out last year. And the gap between outflows coming out of mutual funds into ETFs has grown really to the widest gap ever. And that swing was about 1.5 trillion. This year, again, we're off to a strong start. And we see more issuers coming to market with new products. So it's not just passively managed product, it's certainly active. And now that the investor preference, seems to be accelerating, here at BNY Mellon, we're seeing really a large queue of clients lining up either to enter the ETF market or to bring new products to market. And we think that trend will continue here. And I think we could really be within reach of getting to that $1 trillion mark this year.
So Ben, in terms of standouts, specific ETFs that have offered the best returns over this period as we get ready to get into more traditional quarter-point rate hikes from the Fed?
Well, certainly we've seen investor interest in international equities, which is not something I've been saying much the last couple of years. And if you look at the top of the leaderboard, you see European equities at the top of the leaderboard gathering flow. And certainly they've performed well, with investor sentiment thinking like dollar may have peaked, and certainly valuation seeming attractive. And we started to see a run up there really in the European equities. Also, fixed income is continuing to catch a bid from investors. But what's interesting about that fixed income flow is we're seeing it really across the board. It's high yield, it's investment grade, it's short duration, it's long duration, and we're even seeing sort of the mortgage side of the market also pick up investor interest, really, again, trying to position around expectations around what the Fed may or may not do.
But obviously, a lot of options out there. As you mentioned there, you have the equity ETFs, fixed income. You also have the dividend ETFs as well. For people who are trying to position themselves right now, what sort of allocations should they be looking at?
Well, certainly last year, what we have seen was a real sort of wake-up call. Those who were invested in a traditional 60-40 type allocation had a really rough go of it, really a historic rough go of it. So what we've seen really is a lot of repositioning by investors, looking at those allocations, harvesting tax losses in many cases, and using that opportunity to take a look at other possibilities in their portfolio, specifically to lower cost, reposition tactically, and certainly adjust their fixed income allocations, after the large rout in the bond market last year. And so again, we've seen a historic volume in ETFs that was in place last year. We've seen, again, a strong start here to January, and again, a lot of repositioning. So the advice to investors is really to look at this opportunity to readjust, reallocate your portfolio, and take a look at the new options that are out there, whether it be, again, to offer a new slice of your portfolio with some exposure you didn't have before, lower fees, and again, harvest your taxes as well if there are losses inherent in your allocation.
Well, certainly at least something that for people who don't want to jump with both feet into the market right now with all this uncertainty. ETFs, a great option there. Ben Slavin there, BNY Mellon Global Head of ETFs. Thank you for joining me this morning. All right, coming up, adapting to a new reality. Pharma giant Pfizer signals a sales slowdown is on the horizon, but how much of it is COVID related? We discuss next. Pfizer reporting an earnings beat for the fourth quarter, but issuing some weak guidance for its COVID-19 vaccine products. Yahoo Finance's Anjali Kemlani joins us now with more. We see there the stock under pressure as a result.
That's right, Rochelle. Unfortunately, we know that with everything that is going on with the pandemic as it stands right now, with the White House itself calling for the end of the pandemic in May, the companies, including Pfizer, are now looking for a downgrade in what they expect for sales related to their COVID products. That includes for Pfizer specifically the Comirnaty vaccine that it shares with BioNTech, as well as Paxlovid, the treatment, downgrading those to basically a fraction of what we saw in recent years. 13.5 billion is the revenue estimate for 23, and 8 billion for Paxlovid there you see on your screen. Meanwhile, the company boasting a beyond $100 billion for the first time in full year revenue for 2022. That's the first time the company has reached that high in its 174-year history, I believe. And so that's something that they're pretty excited about. And of course, we know this all comes because of those COVID products. If you look at quarter over quarter, when the company was breaking out its revenue for a time, you saw that operational growth really surpassed, significant numbers. They were just 82%, for example, in the first quarter of 22, compared to without COVID products, an increase of 2%. And you can see on your screen just how that progressed over time. So getting beyond that now, the company is really looking beyond what they can do. So the COVID products is one obstacle. The other one is a loss of exclusivity on some of their products, looking at a hit of $17 billion in the coming years. And that is something that Pfizer's CEO, Albert Bourla, has specifically talked about with recent acquisitions, as well as 19 products in the pipeline, being able to offset that $17 billion. That's the expectation for this year and through the upcoming years. And so we'll have to see how that all pans out. And that's one of the reasons why some analysts, including at Wells Fargo, they downgraded Pfizer recently, hoping to see some of that come to fruition. So right now, the company really focused, kind of back to square one a little bit of where they were pre-pandemic, on trying to focus and prove the point that they are more than just a XYZ company, in this case, more than just a vaccine company and more than just a COVID company. So really setting the stage here, as many of the comments from the executives today, really setting the stage for strong capital allocation, including, by the way, more focus on the commercialization of the COVID vaccine. And that is going to need as well, sales and support. So they're spending on that as well as R&D. So full picture, a lot still going on for Pfizer right now.
So a lot to adjust to as we come off the peak of the pandemic and look for the path forward. Anjali Kemlani, thanks so much. All right, coming up, fresh reporting suggests the National Labor Relations Bureau filed a new complaint against Apple over workers' rights violations. We look at the issues between labor and big tech next. The U.S. labor watchdog is now recommending Apple settle with its former employees, according to reporting by Bloomberg. Now, this comes after its board found evidence supporting claims of harassment and the suppression of worker unions. Yahoo Finance's Ali Garfinkel has the latest. Ali, another development for unions here.
Another development for unions here, definitely, Rochelle. So this is actually kind of a different sort of labor story we have coming out of Apple. The NLRB here has essentially ruled that Apple's policies as they currently exist are violating workers' rights. Now, what does this mean? So what the NLRB is basically saying is that Apple's higher-ups and their imposition of strict confidentiality rules are what violate and limit collective action, that they're even coercive. Now, what is this really all about here? It's really all about how Apple is paranoid about employees leaking information is what we're getting. At the center of this all is a whistleblower who's in the midst of a lawsuit with Apple. Her name is Ashley Jovic, and she used to be a senior engineer program manager at Apple. As part of her case, she submitted a number of documents, including a rather newsworthy email from Tim Cook. The email basically says to workers, hey, here's the deal. We don't want you leaking. We are actually looking for places where you are leaking. So there's been no comment from Jovic or Apple so far. However, based on the complaint and the ruling, it seems like they're also on the hunt to identify and fire anyone who's leaking confidential information. You see it here from this 2021 email that Jovic leaked. We know that leakers constitute a small number of people. We know that people who leak confidential information do not belong here. Apple has been the good guy in the tech unionization story so far in certain ways, especially because they've been the first to come to the table with workers in their Towson, Maryland store. However, this also comes after the NLRB's December ruling that Apple illegally interfered with elections in both New York and Atlanta. So where does this all leave us? In the end, I think it's important to remember that the NLRB has no ability whatsoever to impose punitive damages. However, this does also show that the NLRB is really not letting this go. And it also, I think, gives credence to the claim that Apple is surveilling its employees right on the edge of legality. And sometimes it appears they're crossing the line.
We'll certainly be following in that story. Interesting to see how that plays out. As you mentioned, they're given Apple's appearance, at least, of being first to come to the table when it comes to these unionization pushes. Great stuff there. Ali Garfinkel, thank you so much. All right, well, General Motors reported quarterly results this morning. The company posted better than expected earnings, operating profit, and revenue despite the challenging environment. Well, investors are now focusing on the company's upbeat guidance and aggressive cost reduction plans. Yahoo Finance's Brian Sozzi spoke with GM's Chief Financial Officer, Paul Jacobson, about the quarter earlier. Take a listen.
I just want to give a shout out to the team at General Motors. Last year was a remarkable year when you think about the amount of pressure that we face. We started the year with about $2 billion of inflationary and cost headwinds. We ended the year with over $5 billion, and all we did was set another record. So the team at GM is really doing amazing things. And as we see it, the demand for our vehicles remains strong. When you look at the quality of our launches, the pricing, we had a great December that capped off a great 2022, and 23 is getting off to a good start as well.
Why do you think, I think the earnings beat is really getting the attention here by investors. What are some of the drivers behind that?
Well, what I really want to share with investors is a message of consistency. When we first gave out our guidance at the beginning of last year, there were a lot of skeptics and people that we didn't believe us. And I feel really good about the team's execution. And as we've seen strength across the company, whether it's in pricing for our launches, quality, but also volumes. We said that we thought volumes would be up 25 to 30%. They ended the year up 25%. So really strong showing by the manufacturing, engineering, supply chain teams, our partners in chips, really did a fantastic job. So I would say it's a story of execution, and that execution we think is going to continue into 2023.
You mentioned strong December, Paul, good start to 2023. Does that surprise you, just given where the economy is and all this recession talk we continue to talk about here in the markets?
I think it's a fair question, Brian. We're watching all of the headlines, and we obviously see what you all do too. And there's a lot of cause for concern in the market generally. But what we've seen for our customers, for demand for our new products, for the credit portfolio at GM Financial is continued strength. There's some normalization in the GM Financial portfolio, and their earnings are going to be down off their record highs for the last 2 years, but still a fantastic year when you look at it historically. GM Financial. But the consumer for us remains strong. We're being cautious. Today, we're also rolled out a $2 billion cost reduction program over the next 2 years. That is what I would say is just try to be prudent. I want to be clear, we're not considering any layoffs as part of that. We're going to manage headcount through attrition and targeted hiring for our priorities, but making sure that we're monitoring costs so that if we do find ourselves in a situation where pricing weakens or we see softness in the consumer, we can react more quickly. But certainly we're not seeing any of that in the data, at least through the first month of January.
$2 billion in cost cutting, Paul, that's a very big number. Where will those savings come from if you're not doing any layoffs?
Well, I'd say we're going to continue to drive for reduced complexity in our products. We're going to look at all areas of corporate overhead and discretionary spending. We've been investing heavily in a lot of growth initiatives. We've got to follow that up by making sure that we're capturing efficiency and making sure that we're moving on and stop doing some of those things that aren't as value added anymore. So we're going to challenge the entire company to go get it. We think we'll get about a third to half of that in 2023. But this is something that I would say is just prudent cost management for us to allow us to continue to focus on investing in those priorities that are important going forward.
And the outlook, Paul, for the full year, adjusted operating profits and earnings, also surprising the market positively here. Is a mild recession baked into that outlook?
We're not baking any recessions in. We've said from going back to Investor Day that we were planning on a 15 million unit market in the U.S. It's a little bit softer than kind of where we've seen demand for the last couple of years, but nothing that I would say is significant. Production's trending higher. Our inventories have built up a little bit through the year, but still far from normal levels. We're going to continue to drive lower inventories. We're going to balance production to demand and make sure that we've got vehicles for consumers when they want it. Right now, we're still seeing vehicles on dealer lots at about a third of the level that they were in 2019. So we're focused on trying to balance that out at a lower level that is healthy for both the business and for the consumer.
Do you think we're in a good old-fashioned 80s style price war when it comes to EVs? Two of your competitors are out there chopping prices. What do you think on that, and are you going to respond?
So we've seen incredible demand for our EVs, and we're launching even more this year. And we've seen consumers really run towards them at the price levels that they are. So we feel quite confident with our strategy. Look, competition in this business is no surprise. We've been dealing with it for more than 100 years, and one of the things that I think we've said over time, this isn't an easy business to get into, but one that we're ready for. And when you look at the synergies and the efficiencies we get with the Ultium platform, the broad array of vehicles across all affordability ranges, across all consumer segments, we think we're positioned to win in the EV space, both now and for the long term.
It doesn't sound like then, just given your GM's focus on more affordable EVs, that you do need to cut prices.
Not necessarily cut prices. It's a matter of really putting vehicles across all classes. And I think some of our competitors have struggled with the cost of battery cells, et cetera. Obviously, Tesla's doing incredibly well, and a lot of lessons that I think everybody can learn from them. But at the end of the day, it's about driving efficiencies. And we think with the Ultium platform and with our scale of manufacturing, we can offer vehicles in different classes and different segments at different price points that are better than anything out there, and to be able to do it while hitting our margin targets.
You and I are both car guys here, and from one car guy to another, I have to ask this: why is GM investing almost $900 million in small block V8s? I thought that engine, Paul, was just supposed to be discontinued, and we're plugging everything in.
Well, we continue to believe that the ICE portfolio has really strong value. In fact, it's funding the transformation. And when you look at the results that we saw in 2022 with record levels of free cash flow while investing increasing amounts back in the business, that's coming from the ICE portfolio. But we're also called to make that more efficient. And there's a lot of efficiencies that are coming in to those new engines. And they're going to continue to be around for a while as we transform our vehicles into 100% EVs by 2035.
That was General Motors Chief Financial Officer Paul Jacobson with Yahoo Finance's Brian Sozzi. All right, stay with us. Coming up, Spotify painted a mixed picture in its fourth quarter earnings. We take a deeper dive with the CEO of New Construct, David Traynor, next. Spotify painted a mixed picture in its fourth quarter earnings, posting a wider than expected loss and a beat on gross margins. The company blamed its widening losses on higher personnel and higher advertising costs and said it plans to further scale its podcasting business. But our next guest is not so optimistic on the music giant's podcasting future, saying investors should consider the, quote, hard limit on the profit potential of the segment. Let's get to it with New Construct CEO David Traynor alongside Yahoo Finance's Ali Kanal. Good to have you, David. So first, I want to get your take on this because you really don't see a path forward in terms of where Spotify's profitability is going to come from in this streaming picture.
It's a really tough business. I mean, delivering content over the internet is not a competitive advantage. And when you look at the future cash flow expectations required to justify the stock price, there's a huge disconnect between what we think the business profitability can be and what the market currently expects it to be.
Well, David, let's pick up on that because on the earnings call, Spotify did stress that cost pressures will ease in 2023 as the company pulls back spending across the board. Where would you like to see those cost cuts most concentrated?
I mean, I think across the board is right. I mean, we're showing negative margins, right? So as long as margins are negative, they've got to have like pretty extreme costs to cutting. And I think that's going to be difficult in order to maintain market share and maintain growth. I mean, that marketing and advertising expense is important to compete against all the other streaming services. And that's partly because there's not a lot of differentiation between one streaming service and another. And there maybe never will be, except for original content, which of course is extremely difficult to consistently produce at a high quality level. So yeah, an unprofitable business that's been burning through a lot of cash needs to do whatever it can to get to profitability, but there are going to be trade-offs to that path to profitability that make it difficult for the business to grow into its valuation as well.
You mentioned gross margins. Are you confident that Spotify can hit those targets? They said in the long term, they expect margins between 30 to 35%.
Not really. And I mentioned margins. I'm really talking about the net operating profit after tax margin, like the margin that at the end of the day that investors should care about. Gross margins can be good, but if you're still not generating an after-tax profit positive margin, it sort of doesn't matter that much how good the gross margin is because, you're still not making any money. There's a lot of things they can do in terms of how they calculate a gross margin. We like sort of one version of the truth. The net operating profit after tax margin, return on invested capital. We do spend a lot of time trying to calculate those consistently and accurately across lots of companies. So we can look at a company like Spotify and understand just how competitively disadvantaged it is relative to its peers and other companies.
And I want to talk management. Obviously, we saw a C-suite change. We also saw the layoffs that Spotify had as well. But still, at least they had at least that quarter, that record quarter in terms of subscriber growth. When does all this translate? When does this actually make it a path forward for where Spotify goes from here? Can they do anything in terms of perhaps raising the price of subscriptions or streamlining elsewhere?
Rochelle, that's kind of the catch-22. I mean, it's a great question. Like at the end of the day, are they ever going to generate any cash flow? And I think the answer is, well, maybe, but even if they do get to some positive level of cash flow, it's so far below what's already baked into the stock price in terms of, huge amounts of future cash flow creation. So, there's a disconnect here between valuation and the underlying economics and fundamentals of the business for all the reasons you just laid out. It's going to be tough.
And David, Spotify not raising prices on those US-based subscriptions, despite the price hikes that we've seen from YouTube Premium and Apple Music. Missed opportunity here or a strategic play?
I think a strategic play. I think it speaks to the relative competitive weakness of their business compared to these bigger firms that have bigger, larger platforms that bring a lot more to the table, a whole ecosystem around music, video, pictures, other devices, TV, and Spotify is just a niche little player. So it's going to be really difficult for them to make a lot of money and compete with firms that can offer a very similar service along with a whole lot of other services. Firms like Google and Apple are making tons of money. They can afford to lose a lot of money in streaming music and podcasts without even blinking an eye. Spotify can't.
That's certainly a very stark comparison in terms of the cushion that Apple has. A big thank you to Ali there. David, stick around though, because there's another stock that investors have largely shunned, which is Peloton. The stock down more than 80% over the last year as it continues to run into a series of issues with its products and sales. And as the stock continues to struggle, many are speculating that a big tech firm could sweep in and buy it. Mega shareholder of Peloton, Blackwell's Capital, is pushing the company to sell. And when you think of tech giants like Apple, Disney, Sony, Nike as potential buyers, David, I want to get your thoughts. I know you say the stock could go to zero. Who could this be the strongest play for big tech?
I think that getting a buyout is a Hail Mary, right? Because the business itself is never going to, we think, make much money. And then you say that out loud and you wonder, well, who wants to buy a business that's never going to make much money? What can Peloton do that we can't do? What is special about them that would justify us paying more than, a penny, 15 cents, I don't know, or just building it on our own? And so, look, we have a concept here we call stupid money risk, which means you never know how much somebody might pay. And we've seen plenty of companies that were probably going to go to zero, get bought out for way more than what they deserved. And unfortunately, the acquiring companies have had to incur some major write-downs for those decisions, but stupid money does exist. And Rochelle, I don't really see anybody really making a buy on Peloton unless it gets way, way lower. Why not buy it out of bankruptcy? Why pay a premium now for a product that is really not that differentiated?
And I think that was the problem, because even when they started selling on Amazon, there's a million bikes on there, there's a million treadmills on there as well, very hard. And then to have to pay for more ad spend to compete with some of these products already on there. Is bankruptcy, do you think, really where Peloton's going to end up heading?
We think so. We put it, I think it was the third stock we put on our zombie stock list. And for all those stocks, right, there's a real issue because they're burning so much cash. They got a limited amount of cash flow or cash on the books to sustain that burn. So the clock is ticking, right? Peloton's only got a few more months, I think, of cash. I think the CEO several months ago said, hey, if we don't figure it out in the next 6 months, it's curtains. So this talk about getting bought out is normal in the bankruptcy sort of process. You kind of throw up the white flag and say, hey, we're for sale. Someone buy us. Otherwise, it's going to be to bankruptcy. And a lot of times, shareholders and investors bigger shareholders and investors will rally around trying to get that purchase done because it's way better to sell before you have to go into bankruptcy. Because if they go into bankruptcy, there's nothing for equity holders, right? There's no cash flow. There's debts. There's payables that are going to soak up whatever cash and assets are on the books before equity holders get anything.
So, David, when people look back and dissect what happened with Peloton as a pandemic darling, having its special moment, but not really having that sort of forethought as to what would happen afterwards, what do you think will be the biggest takeaways from the Peloton story?
I think do your diligence, right? Understand that the stock market is not just like an ATM machine. You put money in and you get it out, right? Or it grows. I mean, the stock market is a capital allocation mechanism. And if you're not intelligent about how you allocate your capital, you can lose it all. And that investing in narratives is dangerous because, investing in narratives when there are no fundamentals there usually means that it's a big grift scheme, which is another way of saying it's a method for taking money from the pockets of many and putting it into the pockets of a few bankers and executives. So if you're investing without understanding the fundamentals, understanding the competitive position, you're really taking a big risk that you're going to lose a lot of money. And people just need to understand and get back to sort of the basics of intelligent capital allocation when they think about investing. And Peloton is a great example of if you don't, you can lose it all.
Stark lesson indeed. Don't invest in a narrative. New Construct CEO David Traynor, thank you for joining us this morning.
Thank you.
All right, coming up, it's not just the weather that's gloomy in Britain. The IMF listing the UK as the only advanced economy to see an economic contraction. We'll tell you why after this break.
Cost of living indices have peaked in the last part of last year and are now coming down. Broader measures of inflation that are more exclude energy and food prices, what we call core inflation, these have not yet peaked and come down in many parts of the world.
Well, that was IMF chief economist Pierre-Olivier Gourinchas painting the contrast between the US and other countries still struggling with inflation. Now, one surprising entrant in that second category, the UK, the only leading economy the IMF says will see a recession this year. Now, the bank calling for a contraction of up to 0.6%, citing the country's energy exposures and lower numbers of job seekers compared to other countries, allowing prices to rise unchecked. And of course, still waiting for the hangover of Brexit to kick in all the way in the UK as well. Well, before we go, let's give you a final check of the markets as we head into the noon hour. We see still positive territory, though relatively flat, at least for the Dow. They're just up slightly. They're about 0.25%, 87 points. The S&P 500, they're up 0.2%, up 30 points. And the Nasdaq up 1%. As we keep an eye on what's been happening with the earnings season, seeing how, as everything rolls out, really investors trying to get a gauge on what this means for consumers going forward. We know consumers have been pulling back on spending, and we'll be getting some more bellwether earnings coming out this week. And of course, everyone holding their collective breath from the Fed meeting today. We'll get the Fed announcement tomorrow, so a lot of investors holding back on that as well, expecting that 25 basis point hike. But then this is a new phase that the Fed is entering here. It's gone to that normalcy of 25 basis point hikes. So we'll see how that plays out for consumers and the fears of recession, which haven't come off the table yet. And of course, a lot of analysts debating whether or not this is going to be a deep recession or prolonged stagflation. Well, that'll do it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern. I'll see you then.